Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Joining the half-point hike club, the RBI becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB, of course, tomorrow. The World Bank's warning: the organisation cuts its global growth forecast, warning of prolonged stagflation. Plus, more trouble at Credit Suisse. The company sees a loss at the group-wide level and investment bank in the second quarter. Let's take a look at the futures then. There's divergence between the futures that we're seeing here in Europe versus what we're seeing in the US. You had, of course, some modest gains stateside notched up on Wall Street. In terms of the futures here in Europe, a bit of catch-up and some optimism as well from Asia on the back of regulatory changes in the technology space. We'll dig into that shortly. So this is how things are opening then. The FTSE 100 currently just starting to price. You had, of course, the Chancellor of Exchequer as well, Rishi Sunak, pointing to potential further tax cuts later this year. We know that Prime Minister Boris Johnson, after surviving that vote of confidence, is now looking at rewriting legislation around the controversial Northern Ireland Protocol as part of that Brexit deal. The Spanish IBEX gaining 0.4%. The FTSE 100 now gaining just a little over 0.1%. Again, a positive handoff from Asia. The MSCI Asia Pacific, that benchmark, gaining, and in China as well, particularly the tech stocks. We'll break that down for you. Optimism that maybe some of that regulatory squeeze is starting to ease. The DAX gaining 0.3% or 43 points. The CAC current also higher by 0.2%. Let's switch on and see how things are playing out then. Cross assets, the RBI, of course, that central bank in focus for today, coming out with 50 basis points, as we said in the headline. Rates now in India close to 5%. We're looking ahead to the ECB, the asset purchase program expected to end tomorrow. That announcement we're expecting from Madame Lagarde. The question then is, do you get a hike in July, and is it 25 basis points or 50 basis points? That is a live debate, we know, within the halls of power at the European Central Bank. The future stateside, again, that divergence between what we're seeing in terms of the optimism, the modest optimism here in Europe versus the futures in the US, pointing lower by 0.3%. Euro dollar currently at 106, just softer by a little over 0.1% on the single currency. The US 10-year back below 3%, 299, yields up though around 2 basis points. And here is the HS Tech Index, just to underscore what you've seen. The likes of Alibaba soaring almost 10%, again on the back of some approvals for gaming from the regulators over in China, following that report in the Wall Street Journal around DD and the ending, again, according to that report, of the regulatory probe into that ride-sharing company. HS Tech currently at 4,790, gaining 4%. Let's check in on some of the individual corporate movers. Credit Suisse in our headlines for the right reasons, of course, or for the wrong reasons when it comes to the bank. Another warning around profits, deleveraging of some of their customers, down. Look at that, 3.7% for Credit Suisse. Their woes just continue. A squeeze on investment banking and the group as a whole. Another warning there as they try to rewrite that ship. Inditex, look, gains of more than 3%. At Zara, they managed to push up profits across Inditex to about a 10-year high. They've raised prices for Zara, so they're managing to absorb some of that input costs and passing those costs on to the consumer. Inditex currently up 3.5%. Wizz Air meeting the estimates, currently down 2.4%. They're seeing strong demand, not quite yet back to pre-pandemic levels. They're still looking to add capacity, but of course also warning that the market and the sector remains very volatile. Wizz Air currently down 2.4%. Let's get back to the macro then, and the World Bank cutting its forecast for global growth in 2022 2022 even further, warning that several years of above-average inflation and below-average growth lie ahead, with potentially destabilizing consequences for low and middle-income economies.
Many countries will have a hard time avoiding a recession. We're not in, it's not a global recession yet. It could, the downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years.
Okay, that's as more central banks take aggressive action to tame inflation. The Reserve Bank of India hiked rates by 0.5% this morning, its second increase in as many months. This, as I mentioned, as the ECB is up tomorrow. Let's get more then with Noor Ali from our MLive team and Marcus Morris-Ayton, Allianz Global Investors European Equity Portfolio Manager. Let's start, Noor, with you. Thank you for joining us in the studio. What do you make of this downgrade when it comes to growth from the World Bank? How consequential is this? What does it tell us about the risks, as they say, of stagflation for the global economy?
I can tell you that the camp of pessimists is starting to gain count. You know, earlier last year, not a lot of us were talking about stagflation. We were saying probably not yet, but that's definitely a big risk now, even for emerging markets, even more so. You saw RBI earlier today raise rates. That was expected. And it's a little bit more political in India in particular, because at some point, if inflation remains elevated above 6%, the central bank actually has to write a letter to the government as to why they failed. So it's quite a detrimental issue there.
Okay, Marcus, let's bring you in at this point. Marcus Morris-Ayton from Allianz Global Investors. Good morning, Marcus. Are you starting to position, should you and your clients start to position now for a potential recession?
Well, it's a good question. It's one that we're all pondering on a daily basis. And ultimately, I think the key arbiter of that will be the consumer. On the one hand, we're currently seeing relatively robust consumer spending, and Inditex's results today are testament to that. But on the flip side, consumer sentiment data looks continually very weak. I think that will probably change as we enter the winter and the impact of higher energy prices begins to bite. And ultimately, I think that the really sad factor is it will probably be lower income households that will be most affected by this, because they spend a high proportion of their income on food and energy. So yet again, we see a greater divergence in the equality gap.
The bottom tranche, once again, feeling the most pain. Noor, let's bring you back in at this point as we look ahead to the ECB and whether or not that will be a factor. They weigh up the potential pain across households. You're looking potentially, now the market's pricing in a rate hike in July. The question is 25 basis points or 50 basis points. Can the economy of the Eurozone stomach 50 basis points from the ECB at this point?
I think the countries on the peripheral side, so Italy, Spain, Portugal, might feel the burn a bit more, but you definitely need it. I would love to see the ECB raise rates by 50 basis points. I don't know how likely that's going to be because of just how dovish the central bank is and just how much they have to consider factors of all these different economies. And they're looking at core inflation, which is not as elevated as the headline inflation print is.
Marcus, what are you going to be looking for from the ECB? The inflation forecasts or any guidance on 25 basis points, 50 basis points? What is going to be in focus for you?
Yeah, I think those are the two key factors. Firstly, will be where the ECB see inflation settling, and secondly, really the cadence of rate hikes that they expect. Everyone's aware that we will see a rate hike in July and September. The question is it 25 basis points or is it 50 basis points? And markets seem to be broadly split in the middle at the moment. But Lagarde has certainly kept the door open for a 50 basis point hike. So we will be waiting eagerly to see what happens.
And Marcus, on a sector-by-sector basis, which sector is most vulnerable, at least most exposed to that increase, whether it's 25 basis points or 50 basis points across the Eurozone? What are you looking at?
I think the banking sector is the obvious one in terms of being exposed to rate hikes, and they've clearly struggled with negative and zero rates in Europe for much of the last decade. The other issue is inflation, though, and inflation is really what dictates the rate hikes. And there, the sector that is most exposed is consumer discretionary. But this appears to be very much in buy-side and sell-side models already. Consumer discretionary sector has been the weakest sector in Europe this year. You've got stocks like ASOS and Zalando down 60, 70%. So the market is very much positioned for that. And I think we're approaching a point where if you believe in these business models long term, although the next couple of quarters may be challenging, the valuation opportunities in some of these stocks may be pretty attractive in the coming months.
Okay, the valuation opportunities may be in discretionary. Noor, let's bring you back in just briefly before we let you go and get back to break. In terms of the China factor as a potential catalyst, some now starting to look at China with an optimistic view. Can China prove a catalyst for the Eurozone as well in terms of that demand as the lockdowns start to ease?
Absolutely. China can definitely be the factor that helps risk assets, particularly tech, rise through this growth fear wave that we're seeing through. I know there are growth concerns, but what we're seeing out of China is very optimistic. And I'm looking forward to seeing more regulatory ease when it comes to their common prosperity mantra. We've seen what happened with DD recently. It jumped instantly, just as we've seen reports that they're going to ease that probe into that company. Investors are waiting for these signs to go back into China. And the more we see from China that willingness or that openness to tech companies again, the more we'll see investors come back in.
Marcus, just briefly, do you agree on that?
Yeah, I think China hopefully provides the upside for markets and for those that do want to get bullish. But the challenge, though, is yes, China provides an improvement in demand, but equally a resurgent China and potentially stimulus from China may increase the inflation that we're all seeing at the moment. So I think there's very much a delicate balancing act in terms of how you view those contradictory factors.
Yeah, contradictory impacts on inflation from supply chain easing out of China, but of course that increased demand as well for things like energy, oil in particular. Marcus, you're staying with us. Thank you. Noor Al-Ali, of course, from our MLive team, breaking down some of the key themes. Thank you for coming to the studio this morning. More with Marcus and some of his calls after the break. Let's check in on Credit Suisse, but big corporate stories of the day in terms of that additional profit warning, just another profit warning from the Swiss lender in terms of the second quarter, warning that they're going to be challenging market conditions. That is already happening, largely as a result, or flagging the implications of the conflict in Ukraine, but also monetary tightening and what they describe as client deleveraging. You can see the stock down almost 4%, 3.8% just in the last 2 days. We'll keep across that story, but just again, highlighting the pressures on that Swiss bank as they try to rewrite that ship in the face of a number of scandals, of course, and of course now market volatility and challenges. Right, coming up. Moving on, Boris Johnson presses ahead with legislation to override parts of the Brexit deal as he looks to put the vote on his leadership behind him. We will discuss the UK and plenty more with Marcus Morris-Aiton and get some of his calls as well next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We are 13 minutes into the European trading day. Currently across European equities, losses of about 0.1%. So the futures had been pointed to some upside for European equities. That hasn't materialised, at least in the first 14 minutes or so. The pressure most acutely felt, and the CAC gone down 0.2%. Similar picture over in Italy and Spain as well. Spain, in fact, just holding up to gains of 0.2%, and the FTSE 100 range-bound. Future stateside pointing to losses of between 0.5 and 0.6% on the S&P E-minis. The Nasdaq futures pointing lower by 0.6%. Let's get back to the UK, though, and all things politics, of course. The UK Prime Minister Boris Johnson trying to move past the major rebellion he suffered earlier this week, pressing ahead with legislation to override parts of the Brexit deal. Meanwhile, his Chancellor, Rishi Sunak, has promised to cut taxes at his budget later this year, one of the key demands of some disgruntled Tory lawmakers. Red meat for the Tory backbenchers, some would argue. Still with us is Marcus Morris-Eiton, Allianz Global Investors European Equity Portfolio Manager. Marcus, are the markets, are UK equities, are UK assets, in fact, underpricing political risk?
I don't think they are. I mean, clearly, in many ways, the vote on Monday was much narrower victory for Boris than he probably would have liked. But I think this is a less of a worrying event than perhaps it could have been a few years ago. On the one hand, we must differentiate between a leadership election within a party, where you're unlikely to see a material change in policy, versus a general election. And actually, secondly, the policy differences we have today between Keir Starmer's Labour government and Boris Johnson's Conservative government are relatively small. Both parties are seeking to govern from the centre. So I don't think we have that big left tail risk that we had a couple of years ago, for example, when we had Jeremy Corbyn in charge of the Labour Party. And that's why you're probably seeing a slightly more muted reaction in markets post Monday. The one
How are you thinking about exposure? Marcus,
sorry,
let you finish. I'll let you finish that point. The one challenge for Boris.
I was just going to say, the challenge Boris has is generally when you see a leadership challenge, it's about one disgruntled policy or potentially a very serious challenger for his throne. In this case, it was much rather really a general distrust across the wider party and all factions of that party over Boris's leadership style himself. And that's often much harder to come back from. So I think in answer to your question, this situation will not be resolved immediately, but actually the impact on markets is much less than it could have been.
Do UK equities maintain their relative ability to act as a safe haven? At least it's all relative, but year to date, they have outperformed many of the other major indexes. Do you want to be increasing your exposure to UK equities in this environment?
Yeah, I think UK equities are probably a relatively good place to be at the moment. You look at the sector composition, they're very much exposed to A, defensives, but B, sectors that are performing in this environment, with energy being one, and equally banks if we are to continue to see this rising rate environment. And actually on the flip side, they have very little exposure to tech and consumer discretionary, which has stood them in good stead this year. And remember that UK valuations are significantly below our friends the other side of the Atlantic, even despite the moves that we've seen year to date.
And you've talked about that valuation squeeze on consumer discretionary. What else is looking potentially oversold for you at this point, Marcus?
Well, I'm a growth investor, and it's clearly been a challenging couple of months to be a growth investor. But the upside of that is now we have a multitude of stocks that have actually performed very well from fundamental reasons, but where the valuation has materially come back. So we aren't short of ideas in those higher growth, higher quality names that fundamentally are performing well, but have been hit by the rising rate narrative. And clearly, you've got to be selective. One example would be a company like Adyen, the online payments business. They grew 60% last year. They've grown 50% per annum over the last 5 years. Yet the shares are down 40% year to date on purely valuation grounds. So those are the types of stocks that we really are trying to take advantage of in this environment. I think for those that have a long-term mindset, we will look back at today and recognise that there were some pretty interesting opportunities for the long term.
Okay, so maybe some opportunities within growth. Is it becoming more challenging to find pricing power? You look at the results of Target, the warning there around margins and the profit squeeze. On the flip side, arguably, Inditex holding up pretty well in terms of pricing power. Is that becoming more challenging to find that pricing power within individual equity names?
I think we'll see a growing divergence between those companies with pricing power and those without. And Inditex is a perfect example. This morning they posted gross margins of 60%, which is a 10-year high. So what that shows is they do have the pricing power to be able to pass on these inflationary pressures to their customers. Their prices are 10% higher than they were a year ago, and they're already talking about further price increases in the spring and summer. What potentially will be worrying for the central bank is actually if this pricing power becomes more widespread, because that would be indicative of these inflationary pressures being passed directly onto the consumer, and may indicate that inflationary pressures will be much more sustained than many people believed a couple of months ago.
Okay, Marcus Morris-Eitan, Allianz Global Investors European Equity Portfolio Manager. Thank you for the analysis this morning. Some views there on consumer discretionary and, of course, continue to focus on those companies that hold pricing power. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Morning, Tom. Tech stocks have jumped in China as the government's latest batch of new game approvals bolstered bets that the industry's outlook is on the up. Bilibili and Alibaba led the rally after China's entertainment regulator approved licenses for 60 new games in what is seen as a step towards policy normalization. ExxonMobil, Total Energies and ConocoPhillips are among a group of Western companies poised to win stakes in a multi-billion-dollar project to boost Qatar's gas exports. Sources say state producer Qatar Energy may announce its decision this weekend. Several other firms, including Shell, also bid to be part of the expansion. G-Space, a unit of China's Geely automotive empire, has put its first satellites into space. 9 of its satellites are circling the Earth after being blasted into orbit last week by a Chinese government rocket. It makes Geely one of the first Chinese companies to begin assembling the sort of satellite constellations pioneered by Elon Musk's SpaceX.
We think there are many synergies between auto manufacturing and the aerospace industry. It represents 5G, 5G plus, 6G, and a significant revolution of the future transport of human beings.
That's your Bloomberg Business Flash. Tom?
Alice, thank you very much indeed. Of course, the owner of Geely, Li Shufu, has a major stake in Daimler as well. Right, coming up, Credit Suisse falls after extending its losing streak. We will dig into that top story next. The implications, of course, for that Swiss lender. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open. We are 24 minutes into your European trading day. You're seeing losses across European equities of close to 0.2%. US futures also pointing lower by between 0.5% and 0.6%. The sector that is feeling the most pain at this point here in Europe is the banking sector, down more than 1%. And Credit Suisse is certainly a factor there. The company is falling this morning, close to 6% as things stand, 4.8%, after saying it expects to make a loss at the group-wide level and at its investment bank in the second quarter. It blamed a challenging market after Russia's invasion of Ukraine and tightening monetary conditions. Let's bring in then Tom Metcalfe, who leads our finance coverage here in the city of London. Tom, just break down the key results then, what you took away from this. What is driving the loss at Credit Suisse?
Yeah, look, it's just another bit of bad news for the bank. So, they came out with this statement earlier today, and as you say, pointing at Ukraine, pointing at this higher rate environment. And, for me, the big thing is just like, this is yet another problem for them. We've had it for months and months. I think I've been on here, for about a year now talking about Credit Suisse woes. And I think why investors are reacting so sharply, so something like 6% down, is just this sense that, as much as they come out and say, we've got a handle on this, boom, there's something else coming through. And you just wonder, where does it end? And, they're now looking towards 2023 as sort of the critical year of the turnaround. But, how much faith do investors have that? And judging by the share price, it looks like there's not much out there.
Yeah, currently down 5.6%, as you say. Thomas Gottstein has said this is a crucial year for the business and trying to turn it around. What else are you looking for? What else stood out for you from the statement, and what else are you looking for in the months ahead for this bank?
Yeah, there was an interesting line in the statement, just a line, no further detail, but they talked about sort of further cost measures. So they have a big investor day coming up, I think, at the end of the month, and they'll say they'll, give a bit more detail then. But you wonder what that is. Is that sort of job cuts? Is it kind of pulling back from more business lines? I mean, the interesting thing that statement was they're saying it was the investment bank is going to make a loss. And I think a few days ago, they just came out and said, hey, we're turning a page, we're good to go. And
one of their top bankers, right?
Exactly,
so back
their
in the
top
game.
Investment banker. So it's just slightly odd communications, and perhaps that's partly why the shares are down so much, because they had this message going, hey, we're back on the line again. But.
Okay, Tom Metcalfe, thank you. Watching for that investor day then from Credit Suisse, and potentially any additional details around those costs and ability to cut costs at that bank, which remains challenged, of course. Tom Metcalfe leading up our finance team here in London. Right, coming up, Wizz Air posts results in line with analyst estimates, and it's bullish on summer demand. We take a look at the figures and prospects for the wider low-cost airline sector next, amid a lot of travel chaos across the continent as well. The markets, you're looking at losses of 0.2% here in Europe. Stay with us. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Credit Suisse stumbles. The Swiss bank kicks off today's session deep in the red after warning of a second quarter group-wide loss. Joining the half-point hike club, the RBI becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB tomorrow. Plus, the World Bank's warning. The organisation cuts its global growth forecast, warning of prolonged stagflation. Okay, let's check in then on these markets. The futures have been pointed to some upside here in Europe, but that is not how things have turned out. The World Bank warning in terms of stagflation, so higher inflation, lower growth, cutting their growth forecast for the global economy to around 2.9%, so below the previous estimates of around 3.2%. Currently seeing losses of 0.2% across the European benchmark. The DAX is lower by 37 points, 0.2%. The FTSE 100 here, currently around range bound. You're looking at the Chancellor of Exchequer, Rishi Sunak, saying yesterday that there are potential tax cuts coming later this year. Let's switch on and see how things are breaking up sector by sector then. Banks under pressure, thanks to Credit Suisse largely. Financial services and banks, currently banks down almost 1%. Retail gaining, though, more than 2%. Inditex part of the mix here in terms of that ability to pass on costs to the consumer through the Zara Group. They hit a 10-year high on profitability of the Spanish retail giant. Travel and leisure also up 0.7%. Energy, you've got Brent above $120 a barrel still. And the last time I looked, the US 10-year was just above 3% in terms of that benchmark. So that's the sector-by-sector breakdown. A more modest look in terms of how equities are playing out than maybe the futures have suggested. Future stateside also, the last time I checked, pointing to losses. Let's get to the travel and leisure sector then. Wizz Air reporting a full-year loss as the pandemic continued to impact passenger numbers. The airline's CEO told Bloomberg's Anna Edwards a little earlier that while there are challenges in supply chains and with recruitment, he remains bullish on summer demand.
We are seeing incredibly strong demand. The least issue in the industry at the moment is demand. People are back, people want to fly. Actually, people have some savings to spend. And the issue is a lot more around the supply chain performance right now. But in terms of demand, we are seeing a lot of people booking. I mean, if I just look at the last few weeks, our booking rate is 55% up versus the same period in 2019. So demand is incredibly strong.
So the last thing you have to worry about is demand. Demand is strong. But one of the issues that is creating is, quote-unquote, chaos at UK airports and maybe other places as well. You tell me, is this a UK story or is it elsewhere?
It is not a UK story. I think the UK story is probably a little bit bigger than in the rest of the world, but we are seeing systemic issues across the industry globally. The supply chain is out of labor resources. We are seeing constraints in ATC, air traffic management. We don't have enough controllers in the system. As a result, we are suffering a lot of delays and ending up with cancellations at the end of the day. We are seeing airport security, ground handling, not having sufficient staff. As a result, they are putting a lot of strains on the operation of the industry. Yeah. So that's the issue.
So there's a number of issues you listed there. I mean, how many more flights have you had to cancel than would be normally operational?
I mean, we hardly cancel. I mean, we cancel less than 1% of our flights. But in recent days, the other day, we had to cancel 4% of our flights due to this very distressing operating environment. The industry must restuff itself. We need to get sufficient number of people properly trained to properly operate this industry. We have been maintaining some unproductivity in the system during the COVID period to make sure that when ramp up is coming, actually we are ready to ramp up. Many of the other players, stakeholders in the industry decided to lay people off in a big way, and now here we are, people are back to travel, and they don't have people to support the operation.
Wizz Air CEO and co-founder Joseph Varadi speaking to Bloomberg's Anna Edwards a little earlier. For more, we are joined by Bloomberg's European Airlines reporter Siddharth Philip. Sid, a bullish tone then from Wizz Air. Were there any surprises from these results?
Actually, just the caution that the airlines actually showed in terms of, low-cost carriers were the most bullish about the economy and the rebound in travel. And the sort of pessimism that's creeping in is actually quite interesting because for the most part, low-cost carriers have maintained that demand is relatively inelastic and people tend to trade down every time there's a sort of slowdown in the economy. And with Wizz Air being a little more pessimistic, it does sort of make you pause a little bit.
Okay, so that is something of a question mark then for that company and maybe the broader industry. When it comes to the tensions between the airline industry and the UK government, they're becoming more acute. Tell us what is happening there.
So the UK government and the airline industry has been trading blows on who's responsible for the chaos that we've seen during the recent sort of Easter break and as well most recently during the Jubilee weekend celebrations when a lot of travel was disrupted. There were serious queues at airports as well as people were forced to miss their flights. Flights were cancelled at the last minute. And so the government has come out and said the airline industry was ill-prepared. They didn't have enough staff and they oversold tickets. While the airline industry sort of blamed the government, saying that the sort of ever-changing regulations forced them into the position where they had to sack staff. And actually, because of the sudden ramp-up in demand, they're sort of struggling to bring in staff, as well as delays in processing all those various staff members.
Okay, so the blame game there between the industry and the government, that travel chaos here in the UK certainly and across other parts of Europe continues. Bloomberg's Siddharth Philip, thank you for breaking down the Wizz Air earnings for us and of course the broader sector challenges as we face up to a post-pandemic reality and increased demand. Coming up, the European Banking Authority Chairman Jose Manuel Campa joins us to talk about the sector's exposure to Russia, recession risks and of course what the global monetary tightening means for lenders on a day that the RBI has hiked by 50 basis points as we look ahead to the ECB. Stay with us, this is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal
honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the Open. We are 39, almost 40 minutes into the European trading day. You're looking at losses of around 0.2% across the benchmark. The banking sector, one of those sectors in the red this morning, down 0.8%. And we want to focus in on that sector and the challenges in the months ahead. Let's talk about that then, particularly Europe with the focus there. It hasn't been an easy few months for lenders with the war in Ukraine and, of course, sky-high inflation running above 8% in the Eurozone. Joining us live from Rome, from Goldman Sachs' 26th Annual European Financials Conference is Jose Manuel Campa, European Banking Authority Chairman, also importantly with that experience previously as Secretary of State for the Economy over in Spain. Jose, thank you for joining us this morning. As we look at a higher rates environment, we had the RBI with 50 basis points earlier today, and of course we're looking ahead to the ECB tomorrow and the expectation that asset purchases will end and maybe you'll get a hike in July. Do you expect that higher rates, higher interest rates are going to be net positive for Europe's banks?
Good morning, Tom, first of all, and thank you for inviting me. I think that rates overall should be a good outcome, given that the macroeconomic environment does not deteriorate significantly as a result of the increase in rates. And of course, we're facing very large macroeconomic uncertainties. But when we think about the banking sector in general, higher rates should help them, depending on the business model of the banks, but in general, it should help them in enhancing the net interest income. And as I said before, if the overall economy does not deteriorate significantly, that enhancement in net interest income will come also with maintained, sustained levels of activity and also with not deterioration of credit quality, which of course is the other side of the coin. As we increase rates, that some of the borrowers may have more difficulties confronting their obligations. So in that environment, that should be positive for banks, but of course the balance of the central banks in making sure that they are able to manage a soft landing in the economy will be crucial.
Okay, let's get more of your views then on the other side of the coin, as you say, that credit quality. Are you seeing any evidence? What is your level of concern about potential defaults from clients of European banks, from those borrowers?
I would say that our concern is moderate to high, but increasing. If I may recall, we're coming out of the COVID crisis after 2 years in which we had seen significant decreases on non-performing loans because there were exceptional fiscal and monetary policies put in place, particularly I'm thinking about moratoria and public guarantee schemes provided to borrowers. Many of those policies are fading out. And as they fade out, we were already expecting that there would be an increase in non-performing loans coming out of that situation. On top of that, now we need to add the very much enhanced uncertainty arising from the war, the Russian invasion of the Ukraine, and the impact that that's having on the specific sectors of the economy and also on the economic outlook, as I said before. So we certainly expect that credit will deteriorate. We have already seen that in some of the numbers that have been reported from the first quarters from banks, and that should continue going forward. How much could that deteriorate? Of course, it's very hard to tell at this stage, and it will depend very much, as I said before, on how the overall macroeconomic outlook ends up developing.
And what is that, drawing on your experience, not just at the EBA, but previously as Secretary of State for the Economy of Spain, what is your assessment of the recession risks for the Eurozone? How acute are those risks at this point?
My impression here, I'm listening more to the macroeconomic forecasters, but is that we're seeing the economy clearly cooling down, but we're far off yet from having what I would call at least an EU-wide recession. I have not yet seen any significant institution coming out with outlooks, and today we'll see the OECD coming out with the latest updates. I look forward to looking at those carefully, but I have not seen yet anybody that has forecasted really negative growth across the European Union for a significant period of time going forward. So far, what we're seeing is clearly a decrease in the growth profile, but we're far away yet from what we call a negative growth outlook.
Okay, and you talked about one of the risk factors. Clearly, it's Russia and the conflict in Ukraine. How meaningful is the European banking exposure at this point exposure to Russia and to that conflict?
Yeah, the European bank exposure was very limited from the start of the crisis. You know, when the war started, the exposure of European lenders to Russian counterparties was a little bit above 70 billion. The exposure to Ukraine was a little less than 20 billion. So overall, about 90 billion, which is 0.3% of total risk-weighted assets of the sector. So very small. And since then, actually, some of those exposures have been decreased by firms exiting out of Russia, by banks themselves diminishing their operations. So that part, I think, that is clearly manageable and is not really a serious concern. As I said before, as the crisis develops, as the economic uncertainty develops, of course, we're looking very carefully at how the outlook looks for certain sectors that are more affected for the economy, and for some countries as well that are being more affected by the exposure of their economies to the war.
Okay, is the unwind from Russia, is that done, or is there more to go? Is there further to go with that process? And if there is, how challenging is it?
I think most of the direct exposure that has been that I referred to before have been managed or are being actively managed. So I don't think that's really a serious area of concern. Our focus right now is more about making sure that there is proper implementation of the swift measures and sanctions that have been put by the European Union, but also by the G7, and the banks are complying with the imposition of those sanctions, and making sure, as I said before, that the exposures to the overall macro uncertainty arising from the war, what we call the indirect exposures, continues to be managed properly.
And what's your assessment as we weigh up all of these risks for the banking sector? What is your assessment of the health of their balance sheets and the additional need, potentially additional need for further capital? Are they well capitalized? Can they weather these tensions at this point?
Yeah, I mean, our assessment at the beginning of the year before the war, was that the capital ratios of the banks were good, were high actually. They actually had increased by 40 basis points through the COVID period. They were at 15.4% core equity tier 1. That was the average for the sector as we enter 2022. As we go forward, as I said before, the macro environment still looks to be worse than before, but not as dramatic. Just as a point of comparison, we ran a stress test of the banking sector last year. We published it in July, and there we had a macro scenario that was forecasting a 3.6% decrease in EU GDP growth. And we're far from that situation. And even in that scenario, our assessment was that the banks were robust and would end up coming out of that scenario with a good position of capital. So I think that the starting point of the banks is good. Of course, there's a distribution around the average on these numbers that I'm talking about, and we need to focus on individual institutions, but I don't see really any significant concerns to financial stability at this stage.
When it comes to the question of ESG, the ECB has been critical of European banks for not moving faster on integrating ESG into the way that they operate. Is there a reason for why this has been slow, why the banks have been slow to adjust to this? Do you want to see more action from the banking sector on the question of ESG?
Yeah, to be honest, I think it's an area which we're all late, and I would like to see more action, not just from banks, but from all of us, including regulators, if I may, as well as non-financial corporates. It's a clear and present danger, and we need to move forward to try to address those risks. We've been working actively on this, and I actually just put a consultation paper last month, in which we are asking the industry for feedback on how best to address these concerns from the prudential framework, if there's anything that needs to be done on the existing prudential framework to make sure that we foster in that area. But that's just one of the areas in which we're working. We're just earlier this year we published a requirement for banks that next year will have to publish information on the Pillar 3 on disclosures of their exposures to climate risk, not ESG broadly, but only climate-related risk. And I think this is an agenda we need to continue to push going forward.
Would you expect that they'll face at some point at least ESG capital requirements?
Well, this is a part in which we need to work through. My impression at this stage is that more than ESG capital requirements, we need to address whether there are risks arising from ESG that are not properly covered now within the existing prudential framework. That was the key question that we put in this discussion paper. And the evidence so far, I think, is that we need to gather more evidence, that we don't have enough information, and that we need to work that further. I don't think necessarily that, I think that as long as capital is needed to cover risks, then we should always amend the prudential framework, but we should not amend the prudential framework for other purposes than order to cover potential risks that may arise from the situation.
Okay, Jose Manuel Campo, European Banking Authority Chairman, thank you very much for your time joining us out of Rome this morning, all things European banks and the challenges that sector faces. Right, let's get to the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. The World Bank has slashed its global growth outlook, citing a surge in prices and supply disruption triggered by the war in Ukraine. The lender now expects the world economy to grow 2.9% this year, down from its April forecast of 3.2% and more than the 4% when the year started. Officials say there is a risk stagflation could persist for several years. Angela Merkel has warned that isolating Russia isn't possible in the long term. In her first public appearance in front of a larger audience since leaving office, the former German Chancellor said Putin had made a big mistake by invading Ukraine, saying there's no excuse for this brutal aggression. Sources say Merkel repeatedly spoke to Putin in the early days of the war, calling for a ceasefire. Bloomberg has learned that the Biden administration is seeking to wean the US off of Russian uranium imports. Sources say the White House is pushing lawmakers to support the $4.3 billion plan to boost purchases of the nuclear reactor fuel from domestic producers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Okay, Alice Atkins, thank you. Coming up, Brexit override. Boris Johnson plans to scrap parts of his deal with the EU, but how much can the Prime Minister actually get done after barely surviving that confidence vote? We will explore that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. We are 53 minutes into your European trading day. Losses across European equities of 0.2%, and the futures are not looking positive for the States either. The S&P E-mini is down 0.4%. Similar picture for the Nasdaq futures as well. Okay, let's take a look at some of the things to watch out for today. At 10 a.m. UK time, we will have some Euro area data, including GDP and employment, and ahead, of course, the ECB decision tomorrow. Also at 10 a.m., the OECD Economic Outlook report is released. Then at 5 p.m., we are due Russian CPI. This comes as later today, Russian Foreign Minister Sergei Lavrov is expected to visit Turkey for talks on unblocking Ukraine's grain exports. Now, back to all things politics here in the UK. The UK's Chancellor of the Exchequer, Rishi Sunak, has promised to cut taxes at his next budget. That's in the autumn. It was one of the demands of some members of Boris Johnson's Conservative Party, who, of course, almost deposed the Prime Minister earlier this week. Bloomberg's also learned that Johnson plans to press ahead with legislation to override parts of the Brexit deal. Controversial to say the least. Joining us now is Lizzie Burden, our EMEA EcoGov correspondent. Lizzie, is this an attempt then by Boris Johnson to cynically change the agenda and move away from the vote, the scandal and the pressure on him from within his own party?
You could argue that it's Boris Johnson coming out guns blazing. Even some of the Tory press called it a hollow victory, so why wouldn't you want to move on from that? Or you could question where this is coming from. The Foreign Secretary, Liz Truss, has been trying to show that she's not afraid to stand up to Brussels, even though once upon a time she was a Remainer. And if you look at the timing of this, it's a massive gamble for Boris Johnson. It risks stoking the anger among the pro-EU MPs who voted against him on Monday night. Brussels isn't going to be in a mood to compromise when he's weakened. And if Brussels retaliates with a trade war, it'll only add to the cost of living crisis in the UK. So I would question where this is coming from.
And what would you say about Rishi Sunak's announcement then, that maybe you're going to see tax cuts later this year at the budget? What does it say about his ambitions when he looks at a weakened Prime Minister?
So interestingly, this is tax cuts on business. It'll be interesting to see whether there are also personal tax cuts to help with the cost of living crisis. There's, of course, it's always a benefit to a wannabe Tory leader to try to look like an heir to Margaret Thatcher, a tax cutter.
And so far he's struggled to do that. Because taxes remain very high across the board.
And he's recently increased the windfall tax. He's raised the windfall tax on energy companies. So he's got some ground to claw back in that area. Never mind the fact they had this debacle over his wife's tax affairs. So unsurprisingly, he's slid down the list of runners and riders to replace Boris Johnson.
So possibly some jockeying still at play there within the leadership of the Tory party and, of course, the government. Lizzie Burden, thank you, as ever, for breaking down what is happening here. That controversy, I should say, around the Northern Ireland Protocol, whether that's going to be rewritten, and, of course, that announcement from the Chancellor that maybe there are tax cuts in the offing. In terms of your markets, just checking back in, the FTSE 100, by the way, down now 0.2%. We've been discussing the relative ability for UK assets to look through the increased political risk here in the UK. Currently down 0.2%. The CAC current is low by 0.3%. And when you look at the S&P E-minis, futures pointing lower by 0.4%. We've had 2 days of gains for US equities. That may be unwound later today. Looking ahead, of course, to CPI and that all-important inflation print from the US on Friday. But before we get there, it is the European Central Bank, the ending of the asset purchase program expected to be announced tomorrow, and any clarity on inflation forecasts and the rate of increases. That is it for the European market open. Surveillance early edition up next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Many countries will have a hard time avoiding a recession.
I think that bringing inflation down should be our #1 priority.
The last few years have been challenging in terms of just the volatility that we've seen.
But this is the sharpest slowdown in 80 years.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 8th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The half-point hike club. Well, the RBI becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB tomorrow. More trouble at Credit Suisse. The company sees a loss at the group-wide level and investment bank in the second quarter. The lender weighs a new round of job cuts. And amid questions over his long-term leadership, UK Prime Minister Boris Johnson presses ahead with revisions to the Brexit deal as Rishi Sunak promises to cut taxes in the fall. Now, first thing is first, we do have a lot of top stories, and in the last couple of minutes, actually seconds, we have a Bloomberg scoop saying that Credit Suisse is probably looking at weighing a new round of job cuts after the loss warning that we had earlier. So we'll have, of course, a look at what Credit Suisse stock price is doing. For the moment, you can see European stocks down some 0.4%. They turned lower. U.S. equity futures also lower on persisting worries about high inflation and slowing growth. That, despite a lot of the opening actually being supported by technology stocks in China. You can see Credit Suisse, of course, warning on their profit, down some 7.3%. And then that Bloomberg scoop just seconds ago saying that they're also weighing a new round of job cuts after this loss warning. Now, let's get straight to what the European map looks like. This is one, of course, of a story of inflation. Tomorrow is ECB day, something that will be closely watched. I know, for example, in some of the periphery countries, they're extremely worried that spreads will widen if the ECB does not do something to contain that. So I would suggest getting into tomorrow, and we see that widening of the spread, for example, between Italian BTPs and German bunds, but that is probably one of the main market stories that we should watch out for tomorrow as well. U.S. Treasury Secretary Janet Yellen, meanwhile, told lawmakers that inflation is likely to stay high.
Let me say, I think that bringing inflation down should be our #1 priority. And President Biden, in an op-ed on inflation in recent remarks, has indicated that it is our top priority.
And World Bank President David Malpass is warning of years of pain ahead. Speaking to Bloomberg, he raised the possibility of a global recession, though he said we're not there yet.
Many countries will have a hard time avoiding a recession. It's not a global recession yet. It could, the downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years.
Now we're joined to talk markets and, of course, investments by Rupert Harrison. He's portfolio manager for multi-asset strategies at BlackRock. So many questions, Rupert. First of all, on where do you hide if inflation's coming or a policy mistake could bite us?
Well, look, this is the challenge for markets at the moment. I think we're not past the peak of this inflation problem.
And central banks, so we've got the ECB tomorrow, overwhelmingly focused on inflation and not at all sensitive to what I think is going to be a coming slowdown in growth. I think that might be the story by the time we reach the end of the year, but for now, inflation absolutely the driver of policy. And I think we are, at the moment, maybe in a little bit of a pause in this sell-off in risk assets. Positioning is now extremely low. There's maybe some short-term relief from China as the kind of reopening after some of the COVID lockdowns. But I still think this is not a great environment for risk assets, not a great environment for corporate bonds. We like owning alternatives, gold, other diversifiers in portfolios.
So gold is what, a hedge against inflation? Is crypto a hedge against inflation?
I mean, I don't really see crypto as a hedge against anything. I think it's a speculative asset, really, as a mainstream asset class. I think that gold is a good hedge against fears of inflation. Okay. Ex-post turns out not to be a particularly good hedge against inflation.
Is there a danger that actually we have too many hikes and then they have to cut in 2024, a lot of central banks, and I don't know how you play that in the markets?
Yeah, so look, I think that the policy error narrative is something that I think will emerge particularly in Europe later this year. I think that the slowdown in European growth and in the UK is going to bring, whether we had an actual recession or not, I'm not sure, but I think we will end up with growth very, very low, close to zero. And I think that central banks at the moment are overwhelmingly focused on that inflation challenge, but that growth concern will take over, particularly as the kind of peak inflation data start to recede later in the year. In the US, the fundamentals are just that much stronger. We've already seen
recession.
Well, I think we are seeing a slowdown. I think we're going to see manufacturing PMIs in the ISM, for example, down towards 50 or even below by the end of the year. But we've got a huge amount of balance sheet strength for consumers. We're seeing already actually credit data start to pick up in the US to kind of take up some of the slack. So I think the US has that much more momentum.
Do you worry about the ECB not doing a kind of backstop for the widening of spreads between, for example, Italy and Germany, or is that a market play?
Yeah, look, I think that is a concern. We've obviously heard these sort of suggestions that they have some plan coming to try and narrow the spreads. It's not clear what that, but we've been around this so many times with the constraints of the capital key and things like that. I think in an environment where the central bank is overwhelmingly focused on inflation and where growth is slowing, that's going to remain a concern.
So, but you wouldn't buy any European periphery bonds or anything like that. What would you buy in Europe?
So we continue to like energy equities. I still think that for now that the tightness in those markets, agricultural sector, I think that these are kind of medium-term stories that are going to continue to play out. We continue to be underweight European equities overall. Still think that the growth slowdown is something that is going to drive risk assets generally lower.
So we have a mini survey. I mean, I call it mini, but actually it's quite a mega survey because we ask everyone who comes on which commodity will do best and which will be the worst through year-end.
Best, probably still oil.
Yeah.
Worst, I'm not sure, to be honest. It's.
I mean, dynamics are quite. Again, we're kind of assuming, of course, that the war in Ukraine stays on for a long time. I don't know what's being priced in, or whether markets are moving a little bit away from the immediate impact on war and longer-term inflation prospects.
Yeah, so I think in commodity markets, and particularly energy markets, it's not just about the war in Ukraine. Look, it's going to be very hard to forecast the month-by-month developments there, although I would certainly personally fade any sort of short-term hopes of ceasefires or resolution there. But energy markets are tight for a lot of other reasons. And I think that that's going to remain the case for the foreseeable future.
Rupert, how do you play China? Do you play China?
So yeah, absolutely, we do play China. I think that we've been underweight, neutral to underweight Chinese equities for some time now. We've seen quite a sharp bounce in some parts of the market in response to this reopening. Every now and again, we get these sort of stories and signals that, for example, the sort of regulatory crackdown is easing, policy easing is coming. I think our bias at the moment continues to be to kind of fade that positive news. I don't see a fundamental change in Chinese policy coming. I don't think that they are going to resort to large-scale stimulus. I don't think that there's the ability or will to do that. And I still continue to think that those Chinese assets at the moment require some kind of premium to sort of make them attractive.
Okay, Rupert, thanks so much. Rupert Harrison there from BlackRock stays with us. In the meantime, we also need to look at Credit Suisse. We understand from our Bloomberg reporting that it's weighing a fresh round of job cuts, part of a renewed push to slash costs after it warned this morning of a second quarter loss. Now, the job cuts are according to people familiar with this matter, so it hasn't been confirmed, but certainly on the back of that warning of a second quarter loss, the share price of Credit Suisse down 7.3%. Now, coming up, we talk banks. We also talk about the UK economy with BlackRock's Rupert Harrison, who says it's not all doom and gloom. That's next and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Britain's economy remains in the spotlight as the cost of living soars, the pound sinks, and the tax burden hits the highest level since the 1950s. The UK's Chancellor, Rishi Sunak, has promised to cut taxes at his next budget in autumn to lessen the burden. Now, in the latest piece in the Evening Standard, BlackRock's Rupert Harrison says to ignore the doomsayers, as the UK is and will remain a powerhouse of global services exports. Well, Rupert Harrison is still with us. Rupert, I mean, the idea, and it's true when you speak to money managers like Hoff, say, look, I'm just not comfortable at the moment with the UK because everything we're dealing with, productivity, a labor shortage, inflation is kind of coming to the forefront in the UK and being exacerbated also because of domestic issues. Are you brave enough to invest in the UK right now?
Well, I would have to differentiate between the short term and the medium term. I think you can make an optimistic medium term case. There's a huge number of sectors where the UK is still world leading and has huge opportunities. I think in the short term, I have to agree that I think the energy shock, the growth slowdown, and some of the sort of political risk makes it a very challenging environment. Where I do think there is maybe some opportunities is I think that the Bank of England is very aggressively priced to continue hiking. I think that the kind of growth slowdown will probably overtake that by the end of the year. So probably less negative on gilts than some other bond markets.
Okay, I mean, is it the test case of what, on how difficult it is for central banks to balance this juggle?
Yeah, I mean, in many ways, the Bank of England has unusually been at the forefront of this whole story, right? So like, when we saw those big moves in the front ends of bond markets, a lot of that was led by the Bank of England with kind of very abrupt turnaround to sort of sharp hiking signals. I think that with their latest forecast, we also saw, I think, a sign of things to come, particularly maybe for the ECB later in the year, where they're forced to acknowledge very sharp slowdown in growth towards zero into next year, really highlighting that very stark trade-off that central banks are facing. And it may be that the Bank of England is the first to be forced into some kind of pivot as the growth slowdown starts to bite.
I always say this because I know you're former chief of staff of George Osborne, so you understand not only politics in the country better than most, but also the Conservative Party. Like, what kind of policies and the impact on the economy will we have by the end of the year?
So I think that at the moment, the politics is less of a market issue because I think the fiscal stance of the government has now largely been set. We had that big intervention from Rishi Sunak to deal with the cost of living. It was pretty big. You know, we're talking 1.5% of GDP. I think with him still in number 11 and the Treasury as a sort of someone who cares about the public finances, I would be surprised to see another big loosening in fiscal policy. I think that path has now largely been set. That will help to cushion the slowdown. It will certainly help for those on lower incomes because a lot of that money was focused on them. But I wouldn't expect a kind of big change in the overall policy stance.
Where do you see sterling? Because, I mean, it's been, one of the most interesting, maybe, currencies out there.
Yeah, I mean, still looking to play sterling largely to the downside. I think, as I say, I think the Bank of England is priced relatively aggressively relative to the path we'll see over the next 6 months. I think that concerns around growth and the energy shock will continue to drive lower rather than higher.
Are we underestimating, and this is not only for the UK, but in general, some of the supply chain shocks that companies need to deal with? So we talk a lot about, the companies that have the pricing power and that can bring prices up to deal with inflation, the ones that don't. But some of them also, have struggled to get some of the parts.
Yes, look, what we have all been, I think, or many people have been wrong-footed over the last year to 18 months is the persistence of these problems. And I think we know now that that's going to continue to play out. The sort of on-off of COVID lockdowns in China is the latest thing to kind of prolong that story. I think that supply, and particularly labour supply, actually, is going to be the kind of big defining trend over the next 18 months or so. Like, if we do see labour supply coming back really across the developed world, then that's going to make life a lot easier for central banks. I think that'll be a better story for risk assets. In the UK, interestingly, if you go back 6 to 12 months, it was labour shortages that were the big story. And interestingly, that has resolved itself for most sectors in the UK. So I think that's less of a problem. We actually, interestingly, now have very high levels of immigration again in the UK. And I think that that's, again, coming through in a way to sort of solve some of those labour supply shortages. So that may be a sort of optimistic little silver lining for the UK economy, that those labour supply shortages are really much less acute than they were.
Rupert, thank you so much. As always, Rupert Harrison, they're a portfolio manager for multi-asset strategies at BlackRock, joining us this morning. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Angela Merkel has warned that isolating Russia is not possible in the long term. In her first public appearance in front of a larger audience since leaving office, the former German chancellor said Putin had made a big mistake by invading Ukraine, saying there's no excuse for this brutal aggression. Sources say Merkel repeatedly spoke to Putin in the early days of the war, calling for a ceasefire. Now, Bloomberg has learned that the Biden administration is seeking to wean the U.S. off of Russian uranium imports. Sources say the White House is pushing lawmakers to support the $4.3 billion plan to boost purchases of the nuclear reactor fuel from domestic producers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, hedge funds were tallying gains on their hottest bets in years when Dan Sondheim reached an unusual deal with JP Morgan to go even further. With the bank's help in August 2020, Sondheim's D1 Capital Partners used its stakes in private companies as collateral for borrowing $2 billion that the firm could put towards yet more of those stakes, amongst other things. Now, last year, that focus on private companies looked brilliant as D1 updated its valuations and posted a whopping 70% gain in that part of its portfolio. Now, the industry is bracing for a reckoning. Across Wall Street, billionaire investors and their advisors are urgently trying to figure out how much exposure they have to plunging values in Silicon Valley unicorns and other private ventures. Well, joining us now to discuss all of this is our very own Danny Berger. Danny, you're an expert in hedge funds, so they've basically been dipping their toes into VCs.
Yeah.
But because tech is tanking, it's a bit of a nightmare.
Yeah, it really is. And this is something that, as you were talking about, they're often leverage bets for these hedge funds. So yes, interest rates rise, the valuations of these go down. And hedge funds are kind of in this unfortunate position where a lot of private funds, they are only really assessing these investments. They only have to look at selling them maybe 3 to 7 years. But hedge funds, they'll report quarterly or monthly results. So their clients are looking at that and saying, hey, these are falling. We want to get out. We want to sell these. But they're really hard to sell. I mean, they're a liquid
It's not
asset.
liquid, exactly.
Yeah.
But they were meant to be immune also from volatility.
Right. And of course, that's not true when you have to assess them every month or every quarter, because again, that immune from volatility assumes that you're not marking these to the market every single day. And look, the hedge fund industry has gotten a lot, the private equity industry has gotten a lot of criticism about this as of late as the market has turned. Cliff Asness, for example, he's a hedge fund manager, so maybe a little biased because he just does public equities, called it volatility laundering, basically saying that it's this appearance of illiquidity, or it is illiquidity, but that's making it appear less volatile. But actually, it's just as volatile as everything else. You just don't sell it as often.
All right, Danny, I have so many more questions. I know we'll get you back on to discuss this further. Danny Berger, there, our Daybreak Europe anchor, and you can read our full Big Take. It's a great one. I'll also push it out on social media on NI Big Take Go on the Bloomberg terminal. Coming up, Credit Suisse's string of troubles continues. While the Swiss bank expects a loss for the second quarter, we'll dig into that story next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Credit Suisse says it expects to make a loss at the group-wide level and at its investment bank in the second quarter. Now, it blamed challenging market conditions after Russia's invasion of Ukraine and tightening monetary conditions. Just in the last 20 minutes, also, Bloomberg has learned that the lender may be planning further job cuts. The stock is dropping this morning. I think it's around 7.2% lower, now 6.5% lower. Now, let's bring in Tom Metcalf, who leads our finance coverage here in London. Tom, I mean, they just can't catch a break, right? We also spoke to the chief executive in Davos. He was in a quite cheery mood, or certainly more relaxed, but every time it's a loss or it's something that's not quite working out.
Yeah, here I am again, talking about Credit Suisse again. And I mean, this is particularly extraordinary because I think this week one of their top bankers was coming out saying, hey, we've moved all this, beyond this, we're okay. And then today, statement, another quarterly loss. And then that news just now that, they're obviously looking at more job cuts pretty much across the bank.
So why? I mean, I don't know whether there's an underlying, is it that they just can't get ahead of it, or is it they keep on making mistakes?
Yeah, it's one of those situations. The things they pointed to was Ukraine, the rise in rate environment, but all banks are dealing with this. So it does seem that perhaps they're just kind of continually stumbling over their feet. They just can't draw a line under these number of scandals. So perhaps it's just the cumulative effect of that. And I really think investors, you see with the share price, is really starting to lose patience now.
Yeah, currently down 6.5%. Is there anything else that jumped out at you in the statement?
Well, before about 20 minutes ago, I was going, that's an interesting line about costs. So we know what that kind of probably suggests now. It does sound like they're really, this June 28th meeting when they're doing a deep dive with their investors, that's going to be pretty significant. It sounds like they're really going to lay out how to sort of steady the ship. So it'll be interesting to watch that.
Where does this leave the chief executive?
Well, it's the perpetual conversation around him, right? Like, they've come out and said, look, my mandate's clear. The chairman came out recently and said, he has our full backing. But it's 2 years into his tenure, and it's pretty much just been marked by scandal and the inability to move forward and set a clear path. So his sort of future is definitely in the spotlight.
I mean, there were always rumors about possible mergers or selling off assets. Is any of that going to come back?
I mean, yeah, there's a perpetual sort of rumour in the market, I suppose. I mean, I was looking at the market cap earlier today, and it's something like 16 billion Swiss francs. So, I mean, Credit Suisse right now is extremely sort of cheap in historical terms. But obviously then you look at statements like today and you wonder, who would want to buy it?
Tom, I mean, interest rates going higher doesn't really help them, right? Because this is a whole other set of problems.
Yeah, it's an interesting dynamic there, right? Normally higher interest rates will at least help, most parts of lending, etc. I think what was interesting, as they did flag this in the statement, is Asia in particular, clients seem to be staying on the sidelines, and that is going to really hit their fee income, particularly in wealth, the big growth area that they're targeting. So I think that's probably the worry, is maybe it's the volatility and the uncertainty, and right now it's just they can't catch a break.
Tom, thank you so much. Tom Metcalf there, who leads our finance coverage in London. Now, coming up, a new era of monetary policy for the euro area, maybe ahead as the ECB pivots to confront the threat of inflation. We preview tomorrow's rate decision next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Well, the half-point hike club, the RBI, is something that we need to watch out for. It becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB tomorrow. More trouble at Credit Suisse. The company sees a loss at the group-wide level and investment bank in the second quarter. The lender weighs a new round of job cuts. And amid questions over his long-term leadership, the UK Prime Minister Boris Johnson presses ahead with revisions to the Brexit deal as Rishi Sunak promises to cut taxes in the fall. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it is Wednesday, the 8th of June. Armed with new forecasts and with prices rising at a record pace, ECB President Christine Lagarde and her colleagues look set to end trillions of euros of asset purchases and cement a path of exiting 8 years of negative interest rates at tomorrow's monetary policy meeting. Well, we're now joined by Hedal Mehta, Senior European Economist at Legal & General Investment Management. Hedal, thank you so much for joining us. So many questions on the ECB, because we heard from Christine Lagarde. She tried to get that governing council to be on the same page. A lot of people saying like she tried to do a Draghi, but then we still had calls for hikes. So what are you expecting from the ECB?
So I think obviously in terms of tomorrow's meeting, it's going to be very much talking about the need to act, ending the asset purchases, taking policy away from that kind of extraordinary stimulative level. But I think, the hawks have got the upper hand at the moment, given where inflation is. It's still likely to creep a little bit higher. She's going to face some pressure where she's taken the unprecedented step of laying out effectively the path for the next 2-3 meetings. She's facing quite a challenge.
And Hedal, if you look at money markets, so they're expecting a 50 basis point hike by July. I mean, that's pretty punchy.
Yep, I agree, and completely flies in the face of the gradualism message that they've been trying to tell us for a long time. But the last few months have been, extraordinary in terms of what we've seen, and I think that there's a very high chance that is where they end up going.
Hedal, we made some great charts. Actually, thank you, Valerie, as always, for putting some great charts together with us. Now, we're looking at the balance sheet for the ECB, but maybe we can also look at the components to Eurozone inflation, which is one of the most interesting ones, because a lot of it is also, flights, airplanes. Do you expect inflation to have reached its peak, or can it get much worse from here?
It's most likely close to its peak now, but there are still some risks to the upside. Big unknowns in terms of food prices, energy prices. There are lots of shocks that are still there. I mean, the supply constraints have not all abated either, and exactly how that plays out. Economists' inflation models have been broken for a long time, so I think we have low conviction in that.
And I also have two other great charts. Now, one is basically the bond spread, for example, between Italian and Spanish bonds, and this is one of the biggest concern. I mean, I caught up with actually Italian MPs yesterday, and so they said the ECB has to support them at some level, because otherwise it could be really, really ugly for them. Will the ECB do it?
I'm a bit sceptical that they will do anything concrete other than some sort of verbal intervention in the short term. I mean, there was the speculation recently that they are all willing to sign off on some sort of program. It's just going to be really hard to get another Draghi-esque, whatever it takes moment. And remember, there are lots of people who want the bond purchases to come to an end. exactly fine-tuning the minutiae of it so it can favour one country over another, I think is still going to be difficult.
So if we don't get some kind of agreement, and there were rumors in certain press, what happens to actually Italian BTPs? Do they blow up, and then do we have another crisis on our hands?
I mean, it's a risk, and I think this is why the ECB has to be more gradual than other central banks. They can't afford to shock markets. So where other central banks can be more aggressive in terms of hawkish surprises, trying to bash down inflation expectations, the ECB has to tread more carefully. And maybe that's why we've seen that more telegraphed short-term path. But in the absence of them trying to at least give some, not illusion, but at least some idea that they could step in if really required.
But that won't be enough, right? And I guess, is it a philosophical concern of hiking rates and buying bonds, which is a great Valerie question?
Well, I mean, it's ultimately the market could test the ECB's resolve, and we've seen that before. But we're still a long way away from see where we were 10 years ago with the sovereign debt crisis. Remember, the ECB has a huge chunk of BTPs on its balance sheet, so the Italian Treasury gets a nice kind of kicker from that, where Italian debt financing costs are not as high as the actual yield we all see on our screens.
Yeah. But again, if that, if they don't, I guess, take care of that for the moment, and this is because of Russian gas, right, and the dependence of Italy to Russian gas, then could we see some kind of, I mean, I wouldn't go as far as maybe an IMF program, but could we see a Eurozone crisis back on our hands?
I think we could definitely see spreads widen further from here if there isn't some more support. But I do think that actually the Italian structural budget has actually seen some improvement. Obviously, we've got a bit of fiscal easing going on at the moment, but you can have some reasonable assumptions and still have debt relatively stable.
All right, Hetal, thanks so much. Hetal Mehta there, Senior European Economist at Legal & General Investment Management, joining us this morning. Now, coming up, Deliveroo, Oatly, and Goop. We speak next to the venture capital founder, Frédéric Cour, about how to spot these trends in retail and tech. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the conversation on venture capital. Frédéric Cour has been in the industry since 2001, and he's built a record of spotting trends early in technology and retail. Now he racked up big wins as the first investor in Farfetch and early bets on mobile payments platform Zong and Dailymotion, earning his European awards for investor in the year of 2012 and 2019. Then in 2015, Frédéric launched Felix Capital, which focuses on early-stage investments in digital lifestyle opportunities, new brands, and platforms. Its portfolio includes Deliveroo, Peloton, Oatly, and Gwyneth Paltrow's Goop. Well, we're delighted to be joined by Frédéric Cour. He's Felix Capital founder, and he joins me now. Today, it's also announcing an injection of new funds. It will be doubling in size to $1.2 billion. Frédéric, thank you. I feel like this is a great moment to catch up because you're also doubling in size. You've gotten so many things right. Is there an investment that you regret making, first of all? Is there something that was a mistake? And then we'll get on to your successes.
They are, I think, at the right time, we always make the decision with the data we have. Right. And then the key for us is to not overexpose ourselves with too much capital in the wrong opportunity. So, it's difficult to point to a specific, you're putting me on the spot there. But overall, we are very pleased with the community of founders that we built, which has overall helped us to get to where we are today.
How difficult is it, and first of all, congratulations, of course,
Thank
on
you.
doubling your fund. How difficult is it to understand the trends going forward? So I know we were taken by surprise by inflation. If you look at Netflix, we all thought that we were going to watch more TV, but this was more of a pandemic era thing. So is it more difficult to spot the trends in 2-3 years because of COVID?
I think that today, all our industry, where we are very focused on micro, because we're backing businesses that are typically quite small, and then we back them for the long term. We're sort of humbled by macro, because inflation, interest rates, all of this impacts our industry a lot, especially when we make investment decisions at a certain point that will typically get a reading 5-10 years later. So these things are quite different. Consumer behaviors are where we're focused. Economic environment, that's where we have to navigate. The key is not to make the wrong decision, especially on price, which has been harder.
But it's harder. But I mean, okay, Oatly. I've been drinking Oatly for a long time, and then the valuation came in. I was like, why didn't I think of that? So you spot these trends. A lot of people spot them in their daily lives, but without making money investments. How do you do that?
We spend a lot of time watching people, watching how people live, watching how people, especially younger generations, who are setting trends, and that's and looking at social media, for instance, it's an amazing resource.
Through algorithms.
Well, through data, but also through just watching, through looking at hashtags, looking at what's getting momentum, and younger people in particular, because they're very much setting the direction. Gen Z and millennials, who are now getting older as well, impacting every single generation.
We're still millennials, Frédéric. I'm certainly a millennial at heart.
Me too.
So how, what's the next big trend? What do you want to invest in now?
To some extent, things haven't really changed. The economic environment has changed a lot, but when we look at the micro level, the companies we've backed, for the most part, are still doing really well. Maybe the cost of goods have increased, maybe some of the marketing expenses have increased, but the trends towards people wanting to have a better life thanks to technology, so wellness broadly defined, that's a fundamental trend. The trend towards a more sustainable lifestyle, that's a very long-term trend as well.
In terms of retail or in terms of technology?
Really every aspect of our life, from electric mobility to shared ownership to plant-based eating. This is a very profound trend.
So one of the things that actually surprised me, for example, was payments, the Klarnas of this world, of you pay over a certain amount of time. I mean, I remember speaking to chief executives of big banks saying, this is the next big thing, I want to get in on that. And actually there were doubts of this in the last couple of days.
Well, this trend is very, very strong. Maybe what we've seen in the past couple of years is some exuberance on some of those aspects. So I think, personally, I underestimated the power of buy now, pay later. It's been embraced by consumers in a very compelling way. The question is, what are those companies offering that service worth? Because the unit economics on this service are pretty thin. And so maybe there needs to be a readjustment there.
I mean, do a lot of the companies you're invested in, do they have price elasticity? Because they tend to be on the higher end. Is it easier to pass on consumer costs to them?
So not all on the higher end. I mean, if you look at electric mobility with shared scooters, that's pretty affordable. We backed a company in Germany called YFood, which is offering a kind of meal in a bottle, which costs around 2 to 3 euros. So that's very affordable. There is some price elasticity up to a point. So a lot of what the companies are doing today is looking at their cost base, looking at their margin structure, looking at their offering as well to focus on the best offering.
When it comes to food, do you worry about food accessibility? We also had this pretty incredible story about KFC having to replace the lettuce with cabbage because there was a shortage and it was too expensive.
Well, we haven't seen that at the level where we operate, but obviously that's more of a bigger trend for people to worry about. I think what we are seeing is a rise of interest in experience, in hospitality. The restaurants are full, so people are going back to the real life, and food is very central to this.
The other question is basically if you look at how easy, I don't know if it has been easy actually to raise capital, but what kind of investor do you have invested in you? Is it people that used to be in public markets that rather have it in private?
What we've seen that in our industry in venture capital, we've been lucky to have from the very beginning people who've been thinking long term. We understand that it's important to be invested across cycles. So our fundraising happened pretty fast. More capital we expected from existing investors, typically blue chip institutions, fund of funds, endowments, foundations, and some pension funds, and some new investors as well from the US, but also increasingly from Europe, which is a great sign for Europe.
Brilliant. Frédéric, thank you so much, as always, for coming on. Frédéric Coulter, the founder of Felix Capital. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse says it expects a loss at a group-wide level and at the investment bank in the second quarter. The troubled lender warns market conditions remain challenging after the invasion of Ukraine and monetary tightening across the world. It says that led to weak customer flows and ongoing client deleveraging. Now, tech stocks have jumped in China as the government's latest batch of new game approvals bolstered bets that the industry's outlook is indeed on the up. Bilibili and Alibaba led the rally after China's entertainment regulator approved licenses for 60 new games as what is seen as a step towards policy normalization. Now, Francine, what is the most expensive city in the world to live in as an expat? For the second year in a row, it's Hong Kong. That's according to the ECA International. Higher prices and a strong currency kept the city at the top. New York, Geneva and Tokyo round out the top 5. And that's your Bloomberg Business Flash. Francine, actually, London in the top, it's 4th place now. So quite high there.
I'm not surprised. I feel like my cappuccino has increased by like 30% in the last 6 months. I'm not surprised at all, Leanne.
Well, it's not cappuccinos increasing, Francine. Apparently it's rent. So we're just all paying a lot more rent.
I know, I've seen certain parts of London 25% higher, and then you wonder why people don't want to come back to work in the city. Leanne, as always, thank you so much for the update. Now, the UK's Chancellor of the Exchequer, Rishi Sunak, has promised to cut taxes at his next budget in the autumn. It was one of the demands of some members of Boris Johnson's Conservative Party who almost deposed the Prime Minister this week. Now, Bloomberg's also learned that Johnson plans to press ahead with legislation to override parts of the Brexit deal. Well, joining us now is Lizzie Burden, our EMEA EcoGov correspondent. So, Lizzie, first of all, the latest Brexit news would not only concern the EU, but certain MPs in his party. So is it just diverting attention away from Boris Johnson's issues?
Well, you could argue that this is Boris Johnson coming out guns blazing, trying to draw a line under that vote on Monday, which even some parts of the Tory press have called a hollow victory. But I would question where this is coming from. The Foreign Secretary, Liz Truss, wants to show that she's not afraid to stand up to Brussels. She is one of the runners and riders to replace Boris Johnson. And remember, once upon a time, she was a Remainer. And the reason I question it is the timing. This is such a gamble for Boris Johnson. As you mentioned, he'll stoke the anger of the pro-EU rebels in his party. Brussels isn't going to want to compromise when he's looking weakened. And if they retaliate with a trade war, it's only going to add to the cost of living woes in the UK.
Yeah, I mean, without making any judgment, I just find it incredible because they're the ones that signed the protocol in the first place. The other big news is, of course, the tech news and the Chancellor. Is this, again, him trying to appease the rebel factions that think this is no longer a Conservative government because they're increasing taxes by so much, or is it him trying to be Prime Minister?
Yeah, Sunak, another name on the runners and riders list to replace Boris Johnson, though he slipped down it because of that windfall tax on energy companies. So he's obviously trying to bolster his tax-cutting credentials, but this is a tax cut for business to boost productivity and hopefully wages. Will there be tax cuts, personal tax cuts, to help the poorest households through the cost of living crisis? That remains to be seen.
All right, Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Coming up, Wizz Air sees booming demand from tourists keen for getaways during the summer high season. It's warning on staffing and air traffic control disruption, though, so we'll have plenty more of that story next. And this is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Wizz Air has reported a full-year loss as the pandemic continued to impact passenger numbers. The airline's chief executive told Bloomberg's Anna Edwards a little earlier that the airport disruptions have been felt across the industry.
We are seeing incredibly strong demand. The least issue in the industry at the moment is demand. People are back, people want to fly. Actually, people have some savings to spend. And the issue is a lot more around the supply chain performance right now. But in terms of demand, we are seeing a lot of people booking. I mean, if I just look at the last few weeks, our booking rate is 55% up versus the same period in 2019. So demand is incredibly strong.
So the last thing you have to worry about is demand. Demand is strong. But one of the issues that is creating is, quote-unquote, chaos at UK airports and maybe other places as well. You tell me, is this a UK story or is it elsewhere?
it is not a UK story. I think the UK story is probably a little bit bigger than in the rest of the world, but we are seeing systemic issues across the industry globally. The supply chain is out of labor resources. We are seeing constraints in ATC, air traffic management. We don't have enough controllers in the system. As a result, we are suffering a lot of delays and ending up with cancellations at the end of the day. We are seeing airport security, ground handling not having sufficient staff. As a result, they are putting a lot of strains on the operation of the industry.
Yeah.
So that's the issue.
So there's a number of issues you listed there. I mean, how many more flights have you had to cancel than would be normally operational?
I mean, we hardly cancel. I mean, we cancel less than 1% of our flights. But in recent days, we had a day we had to cancel 4% of our flights due to this very distressing operating environment. The industry must restuff itself. We need to get sufficient number of people properly trained to properly operate this industry. We have been maintaining some unproductivity in the system during the COVID period to make sure that when ramp up is coming, actually we are ready to ramp up. Many of the other players, stakeholders in the industry decided to lay people off in a big way, and now here we are, people are back to travel, and they don't have people to support the operation.
Well, for more on Wizz and the summer travel chaos, we're joined by Bloomberg's European Airlines reporter, Siddharth Phillips. Sid, I mean, first of all, I know we need to talk about Wizz Air, but nobody really wants to travel at the moment because it's an absolute nightmare. It's a chaos. I've done it like 4 times in a week. For Wizz Air, I mean, any real surprises about how they're handling this?
No, I mean, I think the fact that fuel costs are rising is going to be some sort of concern as we go into the summer. But at the same time, we are looking at Wizz, and Wizz has been sort of one of the better off carriers compared with some of its peers like EasyJet and BA, which have had to cancel much more flights.
I mean, BA, we actually have some breaking news out of Brussels Airlines. This is according to the standards, canceling some 148 summer flights. I mean, what is happening to BA? It seems like they're in the doldrums. They cut too many people off, and so can't, there's so many flights that they can't operate.
So BA has been ramping up staffing. I mean, at the height of the pandemic, they did cut about 10,000 staff members. And so they are ramping up, but then at the same time, it is a hard labor market. It is very difficult to hire, and as well as the fact that you need security clearances and other clearances, which take time. So essentially, it's a sort of waiting game against the rush of summer demand.
Yeah. I mean, I'm going to confess that I've always been a huge fan of this airline, and now I'm thinking, like, I need to get somewhere. I'm looking at other airlines. Is there a worry that people will switch to airlines that are considered more reliable?
At the moment, it's sort of sporadic, so it keeps happening to different carriers when you least expect it. So, I mean, it's really hard to plan which carrier is going to have which cancellation at what date. So it's really it is a systemic problem across the board. The UK is facing it much more because obviously we've had the consequences of Brexit. But we've seen issues at airports, including Brussels, in Dublin, in Schiphol, in Amsterdam. So across the board, we are seeing issues with security queues in airports, chaos at sort of check-in counters, and even those cancellations.
Sid, in 10 seconds, what did they miscalculate most? The demand or the cost cuts?
I think it's a question of it's both. So they expected demand to come back sort of more gradual pace, and it's been a massive surge in pent-up demand.
Okay, Sid, as always, thank you so much. I could talk to you about traveling and the chaos of travel for the next 2 hours, but I know you have a full-time job to do. Sid Phillips there, our airlines expert here at Bloomberg. Now, in the meantime, Credit Suisse, definitely left, right, and center for top news. A Bloomberg scoop suggests they're weighing a new round of job cuts after a warning of a second quarter loss. That's according to people familiar with the matter. The share price is down 5%. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kay Lyons, and Anna Edwards. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Many countries will have a hard time avoiding a recession.
I think that bringing inflation down should be our #1 priority.
The last few years have been challenging in terms of just the volatility that we've seen.
But this is the sharpest slowdown in 80 years.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. More trouble at Credit Suisse. Shares are falling after the bank came out with a 6th profit warning in the last 7 quarters. A forecast from billionaire hedge fund manager Ray Dalio. He says central banks will be forced to cut interest rates in 2024 after their economies are hit by stagflation. And Angela Merkel's warning on Russia. The former German chancellor says Vladimir Putin made a big mistake by invading Russia, but isolating Russia in the long term isn't possible. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Lots to discuss then when it comes to geopolitics and when it comes to the global growth story, Kaylee. For the moment, the European global equity risk asset picture seems a little indecisive at the start of this week.
Yeah, and of course, that's as investors continue to weigh both the growth and inflation picture, and we're continuing to see cuts to growth forecasts and elevation to inflation forecasts. We're just getting some breaking headlines out of the OECD, which cuts their global growth forecast to 3% for this year, 2022, then down to 2.8% in 2023. They see euro area inflation at 7% this year, 4.6% next year, while cutting the Eurozone growth outlook down to 2.6% for this year. The U.S. growth outlook for this year cut to 2.5%. And then as for the picture in Asia, the OECD cutting its China growth outlook to 4.4% this year. Of course, that is well below the 5.5% target that Beijing has set out. Now, speaking of China, we did get some better news on the regulatory front, maybe out overnight, with China approving licenses for about 60 video games. That is lifting sentiment that maybe the worst of the regulatory crackdown on Chinese technology companies in particular is over. So that really lifted risk sentiment in the region broadly. The MSCI Asia Pacific Index was up about 0.8% overnight, but the really outperformance came from those technology stocks. The Hang Seng Tech Index up nearly 5 full percentage points. The other big story out of Asia we're following is that the RBI, India's central bank, has joined the 50 basis point rate hike club. With that larger than expected hike to tame inflation, they signal that more is to come. Interestingly, you're not seeing too much reaction in the Indian rupee. It's actually fractionally weaker against the dollar at the moment, trading right around 77.77. But the big story in FX continues to be the Japanese yen. It is the biggest underperformer in both Asia and G10, weaker against the dollar by nearly a full percentage point. We're all the way out at 133.81 on dollar yen. That is the weakest Japanese yen once again in 2 decades.
It's
Matt.
unreal. I mean, imagine if you're Ford or General Motors trying to compete with Honda and Toyota. Sales in this country are putting fat margins on the books of the Asian automakers and not helping the U.S. Car makers at all. S&P futures right now down about 1/3% after a really incredible rally yesterday. I mean, we saw another turnaround in equity markets that was dramatic. So definitely a market that you want to be watching closely. The U.S. 10-year yield still holding steady at 3%. This was interesting after the first auction yesterday in which the Fed didn't play a massive role. I think it was a $44 billion auction of 3-year notes that went fine. NYMEX crude up about 2/3% to $120.22. So TI now over 120. Inflation, you know, you can stop it on household goods and bicycles, as I think we heard from the administration, but not on gas. And Bitcoin right now down about 3%, $30,462. It's really not interesting the last few weeks to watch the price of Bitcoin, but everything going on under the hood is pretty amazing. Anna, Kaylee and I had a great crypto show yesterday. If you didn't see it, you can get it on the internet.
You can get it on the internet. You can go to TV Go. You can watch older episodes of that program and of this one. Let's have a look at what's happening on these European markets right here and now, though, Matt. And we have some negativity across European stocks. We opened up in positive, trying to catch up with the US session of yesterday, but that didn't last long in the face of slightly weaker US futures. So CAC 40 and Xetra DAX both down 0.2%. The London market down 0.1% or so. Retail is a real area of positivity, though, and this is really interesting in the context of all the worrying we've done about Target, about Gap, and all the retailers in the United States that have not done too well of late. This is the picture for European retail today. The sector up by 1.7%, and a lot of this is Inditex, and that is putting an upward sort of fire behind other retailers. Even in the UK, could there be some short covering going on of UK retail stocks is what one broker is talking about today. So here's Inditex up by 4.5%. This is the fast fashion business that owns the Zara label. They seem to be managing their costs okay. They reported a decade high level of profits, and there wasn't much talk about inventories and build-up of inventories. It seems that trading down for more expensive labels is something that could play to the advantage of a business like Inditex. So too for Wizz Air. This is a low-cost airline here in Europe, and they like to give you the same narrative that customers trade down when budgets are tight. The stock moving in the other direction, though, down by 6.7%. Disruption at airports overriding a strong demand picture. He said demand is through the roof, the CEO of Wizz Air, when I spoke to him earlier. Credit Suisse, we're going to get more details on this one, Kaylee, shortly, but I just thought I'd emphasize the share price move we're seeing there. Another profit warning from Credit Suisse as the saga there goes on.
And that is something we will continue to follow throughout this program. We'll have more on that in just a minute. But first, let's take a look at what is ahead today. The Bloomberg Tech Summit will be kicking off with a great lineup of key CEOs, including the chief executives of Uber, Amazon, and MasterCard. Plus, President Biden and the First Lady will be in Los Angeles, California, to host the 9th Summit of the Americas. And finally, on the economic data front, we'll be getting Russia's CPI data out at 12 p.m. New York time, Anna.
Yeah, lots to watch out for then on the macro front. Let's get back to the corporate agenda. I mentioned Credit Suisse, the stock down by 5%. The company issuing its 6th profit warning in 7 quarters. The lender said it is accelerating cost savings across the group. Let's get more then with Bloomberg's Danny Berger. Danny, a focus then on cost cutting at the company. That's what they're saying now.
Exactly, cost cutting. And since then, Bloomberg has also learned that they're going to be concentrating on job cuts as well. According to people from this is ahead of a new update that they will give near the end of this month. But the update they've given us so far, yes, as you say, the 6th quarter in 7 of profit warnings. Not a great look, especially when less than 24 hours ago, the head of investment banking, of global investment banking, was saying, hey, we're back online, taking a victory lap with clients. Well, the investment bank is likely to post loss in the 2nd quarter, as is the entirety of the group. Now, they're blaming very macro forces. They're saying, look, we have a war in Ukraine, and at the same time, there's the inflation issue with monetary policy tightening extremely quickly. But of course, this is something that all banks have to deal with. So they're seeing client flow looking challenging. They're seeing deleveraging at the same time. So you have to wonder how much of this is the big banking picture, how much of it is Credit Suisse, which has lost 30% so far this year, just having a really hard time drawing a line under all of the scandals they've had.
All right, Danny, well, you mentioned the fact that banks broadly are grappling with tightening monetary policy, but Ray Dalio out overnight saying that a couple years from now, what we're going to be talking about is easing. Walk us through his thinking.
Yeah, so these were in comments of Australian Financial Review, hence overnight Australia time. So he said, essentially, we believe we're in tightening mode, and that can cause corrections or downward moves to many financial assets. That pain will force central banks to ease again close to the next presidential election in 2024, predicting a stagflationary environment. We heard it from the World Bank as well, warning about that with David Malpass. So yes, he says rate cuts might come. We are seeing markets in the U.S. starting to price in rates 2 years out, but that's not so unusual when you have this immense amount of rates hikes being priced in now. Sometimes that's just sort of a mathematical equation. But yes, Matt, the warnings are growing.
Oh, hey, Danny, how's it going? Yes, definitely watching that very closely. Bloomberg's Danny Berger, thanks very much. Now, actor Matthew McConaughey made a plea for new gun control during a visit to the White House. That's 2 weeks after the elementary school massacre in his hometown of Uvalde, Texas. Let's get more now with Emily Wilkins, our Bloomberg government reporter, who joins us from Washington, D.C. And Emily, his message seemed really carefully crafted, not to offend the Second Amendment supporters in Texas.
Matthew McConaughey, who really presented himself as a Texan, as someone who grew up shooting guns and who grew up respecting the power that guns have. And that's kind of how we tried to message it when he was at the White House yesterday, gave a very emotional speech. You could kind of see him choking back tears, holding up photos of various students who were killed during the shooting at Robb Elementary School. And he has called for various policies to pass that would help eliminate some of these potential mass shootings, such as raising the age on the minimum age to purchase assault weapons. You saw him call for that in an op-ed, and you've seen him this week meet with lawmakers. He's been on Capitol Hill. He met with Speaker Nancy Pelosi's staff yesterday. He's met with a number of top lawmakers, and he was at the White House yesterday. I was actually speaking with a lawmaker who sat down with McConaughey on Monday in a bipartisan group of lawmakers, and he said that he is optimistic that this is a difficult issue, but he believes that there is a good chance to actually get something done. Of course, exactly what still remains to be a question. Republicans are very concerned about limiting certain types of guns or preventing individuals from getting guns. But there does seem to be potential movement around those red flag laws, which allow guns to be temporarily taken away from individuals who might pose a threat to themselves or others.
And obviously, Emily, this is an issue that will definitely be at the forefront of voters' minds as they head to the polls in November for the midterms. But before we get there, we saw a number of primary races yesterday, including the LA mayor's race. Billionaire Rick Caruso looks like he'll be heading to a runoff with Congressman Karen Bass. What stood out to you most out of yesterday's primary race results?
I think the big takeaway from yesterday's primaries, particularly with the mayor as well as with the attorney general recall, was that Americans do have high concerns right now about crime and crime in their communities. And they want individuals, candidates who are going to really be willing to crack down on that crime and make sure their communities are safe. I mean, this is a similar dynamic that we saw play out last year with the New York mayor's race and Eric Adams ultimately winning that. You've heard President Biden really take on that messaging, talking about their support for the police, wanting to make sure they're backing them, making sure they're lowering crime. But this is an issue that we expect to come up really in a lot of major cities and have a lot of Democrats wind up dealing with. And I think that's something we're just a repeating theme that we're going to see throughout the rest of these primaries and into the general election.
Emily, thanks very much. Emily Wilkins there, Bloomberg government reporter out of Washington, D.C. Now, Russia's foreign minister is in Ankara for talks that may restart grain shipments out of Ukrainian ports on the Black Sea. But Kiev is skeptical of the Kremlin's intentions. Let's get more with Bloomberg's European government team leader, Ben Sills. So, Ben, obviously they're skeptical after they've been under attack for the last, what now, almost 4 months. Can you trust anything that the Kremlin says?
I mean, if you're sat in Kiev, it's very difficult, isn't it? I think the Ukrainians are conscious of the fact that their economy depends upon their ability to export critical commodities, including grain. They're conscious of the fact that the global food supplies, and particularly in countries like Africa, countries like Egypt and other African countries, the Ukrainian grain is really critical to maintaining food supplies, but at the same time, they're not about to send their ships out with Russian escorts. The Ukrainians have been saying they need third party, they need other nations to provide naval escorts, and agreeing that with Moscow looks extremely difficult.
Right, yes. I mean, the Russians saying they're ready to ensure safe passage for ships, but we take on board what you're saying about what Ukraine will make of those kind of commitments and assurances. We've seen also Angela Merkel warning against isolating Russia. So this is a slightly more long-term story, I suppose, Ben. What do we make of this intervention? She hasn't made all that many big interventions, I suppose, since leaving the Chancellery.
No, she's been very low profile. It's in part, this is about defending her legacy. She was a big proponent of building ties with Russia when she was in the Chancellery. That obviously looks questionable now. She's very much in line with Emmanuel Macron, the French president, who was a big ally of hers when she was in power. Macron, with the same line that Merkel is making, has really angered the Ukrainians in recent days with his talk of not humiliating Vladimir Putin. You can kind of understand the long-term rationale, but at the same time, it's a stark contrast with somebody like, for example, Boris Johnson in the UK, who's very much kind of defending, and encouraging the Ukrainians to take a much more bullish approach.
All right, Bloomberg's Ben Sills, thank you so much for joining us. Now, another story we're following is the plight of Cathie Wood's ARK Investment Management. The firm's lineup across 9 ETFs now holds just $15.3 billion, a 48% drop since the start of the year. That's the steepest drop in assets among the 25 largest U.S. ETF issuers. The drawdown in assets is a result of weak performance rather than investors yanking out cash. Now, the firm's flagship ARK Innovation ETF, ARKK, has plunged almost 55% this year, the second worst showing among its funds. It's currently higher by about half of a percent or so in pre-market trading. And don't forget, Bloomberg TV is actually going to have an interview with Cathie Wood herself later today, 1 p.m. Eastern time on ETF IQ, so don't miss that. As for some other stocks you shouldn't miss in pre-market trading this morning, one to point out is actually Western Digital. It said overnight that it's considering strategic alternatives after discussions with activist investor Elliott Management that could see the company split up its two businesses. That stock is up about 3% as a result. And I mentioned earlier the big rally we saw in Chinese tech shares in Asia overnight, and that is feeding right through to those ADRs as there's optimism around those video game license approvals, and if that means the regulatory crackdown is over. After Alibaba rose 11% in Asia, those ADRs up about 5.5% before the bell here in the U.S., Anna.
Lots to talk about this morning, Kaylee, with Callum Pickering, Berenberg senior economist. He'll join us shortly. We'll digest the new lines we've got from the OECD, their reduced estimates for growth this year. We'll get to that conversation. And it was the hottest hedge fund bet in years until it all started melting down. More from our big take story, that's still to come. Plus, how Walmart is dealing with labour and supply volatility. Part of our interview with the company's senior vice president of transportation. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Welcome back to Bloomberg Surveillance. This is the early edition simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kayleigh Lyons here in New York, Anna Edwards in London. Now, we have seen record inflation in the Eurozone. 8.1% is the level right now, and the core number is climbing closer to 4. So the ECB, at least from the German perspective, seems to be way behind the curve. Noor Al-Ali joins us, Bloomberg's Market Live editor, to talk about what's going to happen at tomorrow's meeting in Frankfurt. Noor, what do we expect?
You're absolutely right, Matt. The ECB is definitely behind the curve when it comes to pricing and inflation expectations have gone through the roof for the euro area. The debate now for the ECB is whether or not they continue to tout the 50 basis point hike in July, or if it's going to continue to be 25 basis points. I mean, all the hope is that we do see more of a hawkish turn from the ECB, and we do get those pointers for a 50 basis points move, or at least indicators that that's still on the table so the markets don't go wild.
Noor, good morning. I mean, we've had so many hawkish surprises recently, haven't we? We've had the RBA, we've had the RBI, and that's just in the last 2 days, both of them going more than had been anticipated. What would a hawkish surprise from the ECB tomorrow look like? Because we're not actually expecting a rate hike, as you said. It's about laying the groundwork for the future, and some people are already expecting 50 in July. So how could they be hawkish if they wanted to?
If they confirm that 50 is definitely on the table and it's a real consideration for the euro area. And let's not forget that the first quarter GDP final print today, usually the final is not, a big thing to consider, but it actually showed that GDP grew 0.6%, so that's 0.3% higher than the prelim figures. So you do have some numbers out here that shows you that perhaps the economy is doing well enough for the ECB to come out tomorrow and say, we're happy with 25 basis points. So 50 basis points, definitely the turn that we need to see.
Okay, Noor, thanks very much. Noor Al-Ali of the Bloomberg Markets Live team. And remember, you can get further market analysis. Check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In the UK, Bloomberg's learned that Prime Minister Boris Johnson will go ahead with legislation to override part of the Brexit deal. That risks inflaming tensions with members of his own Conservative Party and the European Union. Johnson's government has been pushing to rewrite the Northern Ireland Protocol. That keeps the region in the EU single market while creating a customs border with the rest of the UK. Western Digital has announced a strategic review that could result in the separation of its two businesses. The announcement came after talks with activist investor Elliott Management and other shareholders. Western Digital is one of the world's largest makers of a type of chip, flash memory. It also makes disk hard drives. And the son of the founder of Walmart, Rob Walton, is leading a group that has agreed to buy the National Football League's Denver Broncos. That would be my team. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. And Matt, obviously, I'm into this story for a number of reasons. The record price, of course, is very, very interesting. The fact that this is a billionaire heir to the Walmart empire is interesting as well. And then also it's the Denver Broncos, which I am a lifelong fan of. We have Russell Wilson,
but why?
New ownership.
Aren't you from Virginia? I mean, just because UVA has the same colors?
Well, I mean, that's just a happy coincidence, Matt. But my dad is from Colorado, born and raised. I had no choice in the matter. So here we are.
I'm sure it goes, yeah, there you go. She's explained it. It goes much deeper. How dare you suggest such a poor reason for an allegiance to a team. I, on the other hand, know nothing about American football, so we'll say nothing. Let's tell you what's coming up on the rest of the program. Callum Pickering, Berenberg senior economist, he joins us. We'll talk to him about expectations, reduced expectations for growth globally and in Europe. The ECB set to come out with its contribution to global tightening tomorrow. We will talk about that next. This is Bloomberg.
end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flights to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. More trouble at Credit Suisse. Shares are falling after the bank came out with its 6th profit warning in the last 7 quarters. Bloomberg's learned it's now considering a fresh round of job cuts. A forecast from billionaire hedge fund founder Ray Dalio. He says central banks will be forced to cut interest rates in 2024 after their economies are hit by stagflation. Dalio told the Australian Financial Review the current tightening mode will cause corrections to many financial assets. And Angela Merkel's warning on Russia. The former German chancellor says Vladimir Putin made a big mistake by invading Russia, but isolating Russia in the longer term isn't possible. Merkel says there's a danger of Putin forming an alliance with China if he gets boxed in. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. We were searching for direction earlier on in the European trading session. Matt, we seem to have found it with weakness in US futures, but a bit of a lack of conviction. I guess we're all waiting for that inflation print at the end of the week.
Well, certainly we're watching for the inflation print and a number of data points, but keep in mind how trading's been this week. I mean, we continue to see these huge turnarounds. So even if you think that we've found a direction for the first 4 hours of trading, it could change by the end of the day. Yesterday we were down in the cash trade, and then we closed up pretty big. So right now S&P futures are off 0.4%. U.S. 10-year yield really little changed at 3.01. We just saw it, the yield coming down, and now we see the yield coming up. So a little bit of a flip-flop there as investors sell off that debt. NYMEX crude still over 120 for Texas Intermediate, 120.62 a barrel, and of course Brent is even higher. So this just adds to the inflation picture. Of course, not the core. The core of inflation is the stuff that you don't need. The stuff that you do need is getting more expensive. And Bitcoin right now down 3%, but still hovering around the seemingly unbreakable 30,000 range at 30,413. Kaylee, what are you seeing in the pre-market?
Matt, when Bitcoin breaks out of that range, I'm going to get us hats. I feel like it'll be worth celebrating because it's been quite a while. As for what's going on in pre-market trading, this is a story we talked about earlier, but the optimism coming through for Chinese technology stocks after China regulators approved 60 video game licenses overnight. That is feeding into the idea that maybe the worst of the regulatory crackdown is indeed over, and that's giving a nice lift to ADRs of Chinese technology companies. Alibaba is up about 5.3%, JD.com by 4.3%. You also have DocuSign hired and announced an expanded partnership with Microsoft overnight, so that's lifting the stock the better part of 5 percentage points. And then a story we also mentioned earlier, Western Digital talking with Elliott, looking at strategic options, potentially the splitting of its 2 businesses. So that stock is up a little more than 4% before the bell as a result, Anna.
Kaylee, European equity markets then a little bit sluggish this morning, down by 0.4%. A lot of sectors in negative territory. I pulled out one that's in positive, though, because it's an interesting comparison transatlantically. The retail sector here in Europe up by 1.6%. A little bit of short covering perhaps going on here as expectations for the retail space have been so damaged of late. But we do see some positivity around Inditex, and here's Inditex, lifting the whole sentiment around that sector. Inditex up by just over 4% today. This is the owner of the Zara chain, of course, and they came out with their numbers, a decade-high profitability, managing their costs okay, and not much talk about inventories, which was, of course, the dominant theme when we talked about Target yesterday, and we've had a lot of gloomy reports coming through from, well, certainly some of the US retailers. Credit Suisse down by 5.25%, and of course, this business has put out a number of profit warnings. This just the latest in a long line, Kaylee, and they say, as we mentioned in our top stories a moment ago, they say that they're going to focus on costs, and we understand that means job cuts.
Yeah, really interesting to watch that saga continuing to play out. It is just bad headline after bad headline for Credit Suisse. Let's bring in now Callum Pickering, Berenberg senior economist, who is joining us now. Callum, we've seen a number of cuts to growth forecasts, raises to inflation forecasts just in the last 24 hours. The OECD, the latest out just this morning, the World Bank yesterday cutting their growth outlook, warning of stagflation, and now Ray Dalio overnight in an interview with the Australian Financial Review said, and this is a quote, "We believe that we are in tightening mode, that can cause corrections or downward moves, ... The pain of that will become great and force the central banks to ease again, probably somewhere close to the next presidential elections in 2024. Callum, what's your take on that?
Well, what we've just seen are two risks which simultaneously cannot occur together. We can't have a world in which we have runaway inflation, which is what the growth revisions are showing, and a world in which we can't afford these higher prices. If we can't afford these higher prices, then the inflation goes away. And so we're going to have to figure out which world we're in. At present, we seem to be in the first world. We have a big, an unbelievably large, in fact, nominal adjustment in the world where we're severely supply constrained. And so in real terms, output is stagnating or it's falling. But in nominal terms, everything is growing. So there's no lack of demand. The risk to watch here is that suddenly we get significant demand destruction in the second half of the year, and this turns into a disinflationary shock. But for now, there's no real evidence that that's happening, and hence central banks should be tightening monetary policy to try and arrest this nominal adjustment.
Callum, why then are we starting to see job cuts pop up all over the place? On a micro level, it's really well illustrated by Tesla, although now Elon Musk has walked it back, and you never know what to believe that comes off of his Twitter account. But he was going to cut 10% of jobs at Tesla, and meanwhile, the waiting lists for their cars are 6, 7, 8, 9 months long.
Yeah. Well, judging by the US JOLTS data, there are 2 job vacancies for every unemployed worker in the US, and that's an unbelievably tight labor market. It's a historically tight labor market. So let's have a 25% drop in labor demand. You still have 1.5 job openings for every unemployed worker. That will push wages up over time. You know, we just need to remember back to the 1970s. Things can get quite bad in a stagflationary environment. If you have this nominal adjustment, which becomes entrenched and aggressive, you can have rising unemployment and rising inflation. And so we just need to end this inflation as fast as possible. If that entails significant demand destruction in a temporarily weaker economy, unfortunately, that's what we're going to have to suffer. The narrow path to a soft landing is getting narrower each month. And so we have 2 problems, inflation and supply. Let's get rid of the inflation and with any luck, allow the private sector just to fix this supply problem over time.
So are central bankers really considering, Bullard, Dalio type scenario where they raise rates steeply at first and only to lower them at the end of next year?
Well, put it this way, central banks have already committed a policy error by overstimulating last year. Question is, can you now overcome that without another policy error, namely a recession? That's going to be difficult. History suggests it's difficult. And so you have 2 problems. If you over-tighten now, then you get a short recession, you get rid of the inflation, and you restart. If you under-tighten, the next recession is even bigger because you have to create deep downturn in demand. You have to generate a lot of unemployment to recalibrate inflation expectations. That's the Volcker scenario that you want to avoid. So if you're a central banker, especially the Fed, especially at the Bank of England, you say, let's play for a soft landing, but actually we need to have a preference for running the risk that has the smallest output loss, which is the over-tightening.
Okay, that's interesting. Good morning to you, Callum. I spoke to one guest this morning who was saying that the UK is the canary in the coal mine for where the global economy goes because of the presence of these stagflationary threats. That was his view at Vanda Research. But your view on the UK, the OECD saying this morning that they think that the UK needs to cut taxes before the economy grinds to a halt. That might sound inflationary. So do we have to decide which problem we're trying to fight here?
Exactly. I mean, to me, that sounds economically illiterate because you have very strong demand growth in the UK. Nominal wages plus bonuses in March in the private sector up 10% year over year. That's consistent with the inflation rate of 10%, and yet the economy is not growing because of supply problems. And so if you add to demand when your problem is supply, all you do is produce more inflation.
Okay, I think to be fair, reading a little lower, I think they said that they don't expect that demand situation to continue. They expect some of it to be destroyed in the future. That's their view. Onto the ECB, we see money markets now wagering on 200 basis points of ECB rate hikes by May 2023. Where is that? That's almost a year from now, Callum. Does that chime with what you're expecting? I mean, how much tightening will we have time for before economies slow down?
Well, look, if economies are slowing down, if we are expecting demand destruction, then we don't want central banks to be doing much. Okay, the inflation problem will essentially cure itself because prices will have risen by too much. The ECB is in a different situation to the Bank of England and the Fed. The ECB faces mainly supply-side inflation, not excessive tightness in labour markets, and no risk that wages suddenly start shooting off to the upside, partly because there's a lot of collective bargaining in the Eurozone, so it acts like a speed bump between inflation expectations and wages. So the ECB can go slow. The Bank of England and the Fed, they potentially have a labour market and wage problem, so they need to address that. If I were at the ECB, they'll probably hike in the next couple of meetings, not this one this week, but they should be going a little bit slower.
Callum, I obviously cover a lot of the U.S. stocks here, as well as retailers, which have been in focus over the last several weeks. And Target, in just a 3-week span, has warned about its profit twice, cutting the margin outlook again yesterday, talking about these inflationary forces, the buildup of inventories that they now have to mark down merchandise to get rid of. What is the economic impact if we see others following suit?
Well, the risk is that we're already in a recession, unfortunately. Probably you got about a 40% chance of that outcome in the US. But we often think that the recession is the problem. No, the problem came earlier. The problem came because of necessary, but unfortunately highly distortive restrictions from COVID, the excessive Fed stimulus, the needless stimulus checks, similar policies in the UK and Europe, and now the economy just has to work all of this out. A recession is a normal part of a business cycle. We want to avoid them if we can, but we need to realize the problem is not the recession, it's what came before it that caused the recession. The recession may actually be the solution. If it gets rid of the inflation, if it gives supply chains just a little more time to adjust, then we should allow this to play out and then look beyond it. If we look beyond it, what we see is actually fundamentals are pretty good. If we can just give this process a little bit of time, I'd expect probably a year and a half from now, a pretty decent business cycle to emerge.
Right, and I'm guessing China maybe still plays an important role in where we go later in the year on that front. Callum, thank you very much. Callum Pickering joining us there from Berenberg. Coming up on the programme, it was the hottest hedge fund bet in years until it all started melting down. More from our big take story around hedge funds. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayleigh Lyons in New York and Anna Edwards in London. Now, it was the hottest hedge fund bet in years. D1 Capital Partners used its stakes in private companies as collateral for borrowing billions and posted massive gains. But now, as valuations are fading, the industry is bracing for a reckoning. Our hedge fund reporter, Hema Parmar, joins us now to talk about not only the fact that they borrowed billions on these private stakes, but then they reinvested it in the same kind of assets. And so now as those fall, they're just losing a ton.
Yeah, and we're seeing this kind of across the industry. D1 is one of the bigger players when we look at hedge funds that are doing both public and private companies. And they've really sort of ramped up over the years. But now as we see, different ways that they can go about increasing their allocations to privates, taking on a loan to do so. But the industry is kind of going through this reckoning now as they look at how things are trading.
Well, how much exposure are we talking about when it comes to some of these more illiquid assets?
So, for example, D1, about half of their assets are in private investments. They're about a $20 billion hedge fund. Some of the other funds that have moved significantly into the space, Tiger Global,
By the way,
Viking.
half of their investments, and how leveraged up are they?
Well, we don't always have clear access into how much leverage they're using on everything, but clearly they've taken this, $2 billion loan. They've used some of that to reinvest in these sorts of private illiquid companies, and this is a big part of what D1 does, which is really pushing into startups, venture capital, more private equity type investments, and they are one of the bigger names in the industry that does this.
What do clients do when they're looking at the valuations of these assets being written down and yet they can't necessarily pull their money out easily? I mean, is this not a reputational problem for these funds?
Well, the investors do know from day one that when they invest in D1 and when they invest likely in other funds that do this, that these assets are likely going to be side-pocketed. So when you invest in it, you get in and then you get out when this private investment is exited in some way. They're often told that at the beginning, and we've been seeing a couple other funds like Tiger and Co. too saying, you know what, guys, if you want your money back, we're going to have to side pocket it as to be prudent for your money, but it means that they're not going to be able to get it back soon.
And so, Hema, how do these hedge funds consider the value or show the value of these investments in their books? And how frequently, I suppose, do they have to update those? I mean, you have this concept of mark to market, but when it's a private business, I wonder, what are the rules about how they have to hold the value of these assets?
So typically they will mark quarterly. Some funds that do more like venture capital stuff will, like a venture capital fund could mark annually. But each fund can mark things differently, and according to their own valuation policy. They can take different things into account, such as the fundraising round that was most recent, financials about the company, a basket of public companies that are very similar to the private company. And so these things can influence how they value the position, but it's not uncommon to see, different funds using their own methodology. They do have to do what they tell investors they're going to do and abide by their own policies, but different funds, depending on when they get in these companies, can have different marks for the same company.
So I suppose, Hema, that they will be, from what you said then, if they're using maybe publicly available movements in share prices, for example, as a kind of proxy for what they're holding, then they will be having to represent these losses fairly shortly.
Yes, we've seen some already in some of the funds, marking down things like Instacart, marking down a number of other private companies. Some of the funds like D1 will be marking quarterly, so at the end of this month, I think people are going to be keeping a very close eye to see what the marks are looking like, and I think the industry really is expecting a great deal of markdowns across the space as we look through the rest of this year.
Who are the winners that you're focused on? We hear so much about the losers, and it's a fantastic piece of reporting. I read it top to bottom as soon as I saw it. But who are the winners this year?
So, you know, we're seeing some success among the macro funds. We're seeing success among the multi-strat funds. These are funds that are a great deal more diversified. They can trade currencies as well as stocks. They can some of them are market neutral, meaning they try to trade in a way that's not parallel to the market. And we're seeing a little bit more less volatility in those types of managers, while among the stock pickers or those that focus on public and private companies together, we're seeing a little bit more of a difficult time.
Hema, thanks very much. Bloomberg's Hema Palmer joining us there with more on the big take story. NI Big Take, that is the function to use on the Bloomberg to get a look at the big take story that we put out daily. Now, coming up on this program, how Walmart is dealing with labor and supply volatility, part of our interview with the company's Senior Vice President of Transportation next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, Walmart's Senior VP of Transportation, Fernando Cortez, says the retailer has endured years of volatility. He spoke with Bloomberg's Ed Ludlow from the UP Summit in Bentonville, Arkansas, on Walmart's business challenges.
The last few years have been challenging in terms of just the volatility that we've seen around, whether it's labor or whether it's capacity or just availability of goods. So we've had multiple challenges, but we have a very strong backbone, good partners, good vendors, and an impressive kind of group of associates that are always willing to kind of go and adapt and give the best that we can for our customers. So I would tell you that it's been challenging times, but we've been giving it a good fight, and we're excited about the future.
When you look around Crystal Bridges, the hangar over at Bentonville Municipal Airport, what were the technologies that kind of caught your eye? You know, is there anything that you saw and thought, I can integrate this into my fleet. I can use this.
Oh, there's so many, right? I mean, I'm an engineer by training, so I always kind of love electronics and kind of put them apart and separate them and kind of understand how they build. So yes, I mean, it was just like a kid on a candy store. So a lot of applications. I think you will continue to hear more on how we are thinking about them, but really exciting times here.
You also know supply chains. I think one thing that I was really interested in, I spoke to Stuart Walton about, is that short haul routes, you know, jumping just a few miles, traditionally done by truck or done by van. Now you have options like drone. You know, do you see the proportion of trucks in your fleet coming down and other technologies going up as the years go by?
Well, one of the things that we've had in the last couple of years with e-commerce growing and consumer preference changing on how they want to interact, whether it's a delivery or a pickup or just shopping at our stores, have given us the opportunity to kind of build this last mile solution from scratch. So that's, I think, where you will see more of these new technologies doing different things, whether it's electric, drones, zip line, kind of parachutes, all of these things that we're testing, and they're very, very exciting.
That was Walmart's Fernando Cortez with Bloomberg's Ed Ludlow. Now for what else we're watching today. And what I'm watching is kind of related to the idea of transport and logistics, because we have an interview with Emily Chang and Amazon CEO
We're right next
Andy
to each other.
Jassy. I am sitting next to Matt.
It always disturbs me.
As
I
you
know,
can
I
see.
understand why, but when we're in boxes and we're right next to each other, obviously I'm listening. Anyway, I'm sorry to the director.
And Anna is here in spirit, obviously. But Anna, I think I'm really looking forward to this conversation with Andy Jassy, just because of these kind of same issues, the idea of how expensive that transport and freight have gotten, and the labor issues as well. Plus, that's not the only conversation that will be happening at this tech summit. There will also be an interview around 12 p.m. Eastern time with Dara Khosrowshahi, who's the CEO of Uber. Then later on this evening, we'll be talking with the CEO of Expedia, Peter Kern. We got the CEOs of MasterCard in there as well. So it'll be really exciting to watch all of those interviews. And there's another interview on one of Matt's shows later that I'm also looking forward to.
Well, so you just saw Ed there at the UP conference in Bentonville, Arkansas, and I think this is a really cool idea. Stuart Walton yesterday was saying, look, there's over $1 trillion of capital there that could be funneled into startups and make Bentonville, Arkansas, you know, the hub for mobility startups. One of the people who's been the biggest bettor on mobility startups is Cathie Wood. We've been talking about her hedge funds today because they've been bleeding assets. I mean, down 48% year to date, the biggest ETF issuer, asset loser this year, but still a huge figure. And so Ed's going to sit down and talk to her out of Bentonville this afternoon, and we're going to play that on the ETF show. So join us at 1 p.m. and hear from Cathie Wood.
That'll be great. And I'm very sorry I interrupted your dynamic. I was like, look, I'm doing it again. But I'm glad you rediscovered your physical connection. Matt, I'm talking about rates. And this is inspired by you, actually, because you asked yesterday, one of our guests, is 50 the new 25 when it comes to rate hikes? And I thought that was really interesting. And last night we heard from the RBI. They increased rates by a surprisingly high amount. And today we're going to hear from Poland. Interest rates set to go up by 75 basis points. This will be the 9th straight month we're seeing this from Poland. So a lot to talk about there. But this is a broader picture. Now, more than 50 monetary policy authorities around the world have increased rates by 50 basis points in one go so far this year, which I think is a really interesting statistic and tells us a lot about where we are in the rate hiking cycle. That is it for early edition. Surveillance is ahead. Lots more to come. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This may be the first quarter that we start to see a noticeable hit to profit margins.
Margin is at risk of further compression, and earnings expectation for this year is perhaps too rosy.
What we have here is the consumers reposition very quickly.
Lower income households are going to have a harder time, and we are going to see some pulling back.
What these companies are doing is acknowledging that there is weakness ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Just one more downgrade to global growth from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down a third of 1% on the S&P. TK, the OECD joining the World Bank to try and look ahead to the next year or two.
Every 1/10% makes a difference, John. John, it's like Dow 10,000 is how I'd put it. Global growth of 3% is Dow 10,000. 2.9% feels way different from 3%. WTO and World Bank sub 3%. OECD comes in at a solid 3.
That's how you lose me, Tom, and lose me early on in the show. But I'll move past it because we're friends.
First 30 seconds.
It didn't take him long, did it? It didn't take him long, Bramo. Let's get it back on the rails, on the tracks. TK, 133 pushing 134. $-yen.
The calculus of June is worth noting. Things are not unraveling, John. I don't want to be inflammatory, but the market, when you look at the Bloomberg, is absolutely fascinating. As Vincent Reinhardt with us yesterday would say, level doesn't matter. It's the rate of change, the first derivative, and the rate of change of the rate of change, the second derivative, and they are in play now. German 10-year in Japan. We could spend the whole show on Japan and so on.
Well, let's start there. Let's question that word. Market. Lisa, the Japanese government bond market, the 10-year, did not trade once in yesterday's session. Literally not once. Today, yields higher in the US, higher in Germany. What are they doing in Japan? Nothing at all, because the BOJ is sitting there capping yields. They're increasingly isolated. We've talked about that shock absorber. It's in the FX market, and everybody else is pushing against it.
So Tom just has to mention the Dow. You have to mention the JGB market being a market, and that's going to tweak me because, frankly, it is not a market. There is nothing markety about this. It is completely controlled by the Bank of Japan. At least they're trying to. And as you said, the pressure reliever really is coming from the currency pairs that we're seeing have a dramatic ramification here. At what point does Japan care? Japan's still trying to frame this as a good thing, that their exports are going to be more plentiful, are going to be more available to the world, that possibly they could get tourism. Really? Are we really buying that this could actually give a support to their economy, or is this being viewed as a massive headwind? And that is the tension they're going to have to address heading into year end.
What will they tolerate? Governor Kuroda has got a two-handle on inflation in Japan at a national level. What are we looking at in Europe, in the US? 8 handles and maybe 7, 6 through the rest of this year?
Yeah, and frankly, we're talking about Europe. The GDP estimates came out this morning higher than people had previously expected for this year. And this actually gives the ECB more leeway to raise rates, people are speculating, because growth is hanging in there a bit more than people had previously expected in the face of inflation. All of this pointing to rate hikes in all of the developed markets, the likes we have not seen for decades, and Japan moving in the opposite direction.
I have to admit, growth estimates from the World Bank, the OECD, the IMF, they don't get me excited, Tom. Usually they are about 3, 4, 5, 6 months late. Yeah. We'll say this, though, about Europe when it comes to the OECD. They're looking at 1.6% growth next year. They're looking at 4.6% inflation. That is not the scenario, the base case of this ECB as they meet this Thursday.
John, two quick observations. One is the 2023 guesstimates. In many cases, there's a guess, and then there's a lower guess for the year following. I need to go back to Japan, John. I think it's so important. And the massive distinction of Japan is this is not your father's Japanese analysis. We've got Morgan Stanley coming up here. They have the giant Robbie Feldman in Tokyo, and he would point out that this is a Japan that is now a heavy importer of goods and raw materials. That was not the case when they were moving Toyotas out the door.
Let's get to it, Tom. Futures down about 0.4% on the S&P 500. On the NASDAQ 100, we're lower by about 1/3%. Yields climbing by 2 or 3 basis points on a 10-year, getting comfortable in and around 3% over the last couple of days. And looking at crude, Lisa, 121, and look out, $5 a gallon. The average gas price in the United States, we're getting closer and closer to that 5 handle.
And how much is that going to be the key election issue as we head into the midterms? Today, President Biden is heading to Los Angeles for the 9th Summit of the Americas. The key issue here is that Cuba, Venezuela, and Nicaragua, all were not invited, creating some issues with Mexico's leadership. Interesting to see how people can talk about nearshoring a lot of manufacturing at a time when there is this concern about supply chain disruptions. Today, as Kaylee was talking about earlier, Bloomberg's Tech Summit is taking place in San Francisco. Interesting to see what we can hear from the CEOs of Uber, Expedia, as well as MasterCard, looking to how we can gauge the slowdown in the consumer appetite, as well as some of the shifts in technology right now. And today, Russian Foreign Minister Sergei Lavrov is heading over to Turkey to talk about unblocking the Black Sea for grain shipments out of Ukraine. How much is this real talks, right? I mean, we've heard real skepticism from Kyiv about how much could actually get achieved here. But this is key in terms of the world's food supply, John, so a lot of people are watching this.
Bramo, thank you. I want to turn now to Brian Weinstein, the head of global fixed income over at Morgan Stanley Investment Management. Brian, you said this: the Fed may keep hiking in clips of 50 basis points until something breaks. Can we talk about that something breaking and maybe have a little look at what's happening in Japan over the last few months?
Sure. Yeah, you mentioned it earlier. Well, first of all, I mean, the Fed has to keep hiking 50 basis points until there's some semblance of a demand slowdown, because that's all they've got, right? They can't help the supply side. And so the Fed is on a mission here. And then you said before about markets. I mean, we've seen a couple of these markets really teeter. Japan not trading is probably an extreme example, but you saw the high yield market gap 50 or 100 basis points higher and then 50 basis points tighter. There is just a lot of uncertainty out there. It's been a long time since the Fed couldn't bail us out, and it's going to keep going until there's an accident somewhere.
Brian, James Gorman doesn't want you to talk about second derivative dynamics out there, but let's go first derivative right now. Where is the rate of change right now that interests you most?
You know, I think we're getting back to looking at interest rates again. I think the credit market's adjusted. 10-year notes, I think, have an uneasy truce at this 3% round number. But I think it's pretty clear that we're not going to rally a lot. In other words, we're not going to wake up with a 2.25 10-year note. It's not the direction of travel. So I think the question is, are we going to have this market move to an uncomfortable level, or a level where investors will choose income over capital appreciation, where they'll buy fixed income over equities? We had a few moments of it at 320, and I think we're going to test higher levels again.
We're going to test higher levels again. Why? Which investors are stepping back? Which investors are not coming back to Treasury yields for income?
Well, I think there's two things. One is that the Fed, I think, played this game a bit with a pause. I think that was maybe just to calm markets temporarily. I don't think we can predict a pause given what we're seeing in labor markets, given what we're seeing in relatively strong growth, and given what we're seeing in inflation. So I guess the first thing, Lisa, is that we just don't see investors flocking to fixed income, and there's still a lot more coming, and obviously QT is part of that. So I think that's the first thing. The second part, I think, is really just unease with inflation and growth. growth, I don't think are going to see the turnaround as quickly as people want to in order to flock to safety. So I just don't think a 3% 10-year note with 8% inflation is enough to change the dynamic of this market.
Brian, you talk about an accident. Can we talk about the anatomy of a market accident, what it looks like in this new world? Is it credit-based, given the fact that you've got the likes of Deutsche Bank saying that they are going to see some sort of increase in defaults in the next couple of years, or is it somewhere else?
You know, listen, I think in credit we understand that default rate will go up, right? I think it's somewhere, as maybe John was hinting at, that it's liquidity based, right? That people expect infinite liquidity at a price. But what you're seeing is less stuff trading, right? Again, Japan trading 0 10-year notes is a bit of an anomaly. But in the gappy moves we've seen in credit, for example, I don't think you've had a significant amount trading. So I think all it needs to be is we wake up one day and the JGB is not at 25, it's at 35, and that could unhinge the rate market, which could cause liquidity, people just to pull back and then things to have gappy price action. So I don't think we're talking about some esoteric crisis. It just could simply be that price discovery moves very, very quickly and surprises people on the wrong side.
I know a lot of people in fixed income who are dying for the return of price discovery in certain markets. Nudge, nudge, hint, hint, the JGB market for one. Brian, thank you. Brian Weinstein there at Morgan Stanley Investment Management. Thank you, sir. Lisa, looking for pockets of leverage. Where's the leverage? I hear that a lot. Where's the leverage? Household balance sheets are pretty strong. Corporate balance sheets, we're told repeatedly, are pretty strong. The fundamentals are decent. Can we talk about a firm? A firm, yes, and some of these loans that they've made not going as well as some people might have hoped for. They have got 12.7 million customers. They extended around $3.9 billion of loans in the first 3 months of 2022. The stock is down over 80% this year. The team here at Bloomberg pointing out that some of these loan packages, the value of them is going in the wrong direction.
So this is the classic buy now, pay later, and people aren't paying later after they've bought. And that seems to be the warning coming from the securitizations, right? These loans to consumers that have been packaged and then sold as bonds to investors. People who are analyzing the credit quality of those securitizations are seeing a deterioration, which is leading to some concerns about the consumer balance sheet. When do they start pushing back? When do basically the base costs of everything that they're buying start to impact how much they're willing to spend?
That's one to watch. I'm going to catch up with Judy Beard a little bit later this morning, who is also on board with this story, that this could become a problem for some of these names in a much bigger way. Here's a problem for Credit Suisse, Tom. The 6th profit warning in 7 quarters.
You're going to go there, are you?
We've got to go there. The 6th profit warning in 7 quarters. The team here at Bloomberg reporting, Tom, job cuts could be coming. Tom, what a change in the last 12 months.
John,
to have all these banks loading up on talent, fighting for talent, and now reports of more job cuts to come at a company that's really struggling to provide a guide for the path forward.
John, paragraph 42 of my agreement with Bloomberg says I only talk about Credit Suisse at Brasserie Lipp in Zurich. I mean, over, a $42 omelet.
And a strong drink.
Yeah, that would be true. They need a strong drink. This has been a train wreck for 30 years. I don't want to go into it, other than Mr. Gottstein has a lot of courage to make tough decisions. John, this is a key phrase. Culturally, they don't want to make them. This is about culture and nationhood, not finance.
When does the patience, Lisa, of David Harrow and others run out with this name?
Yeah, that was my first question. My next question is I want to read Tom's contract about when he'll talk about certain things, what he has to be eating, and where he has to be while he's discussing.
Forget the food. This is not about the blue M&Ms. This is all about a drink. It always is.
I liked how Brian at Morgan Stanley, he mentioned 3 as a round handle. I mean, that's like Dow 10,000.
You're going to keep bringing that up?
Yeah.
Okay. Do you want to quote it now?
No, I want to look seriously.
I'm pleased you're serious.
John, as Lisa mentioned, the credit report, the credit card report from the Fed yesterday was stunning.
Let's pick up on that in a minute. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. More problems for Credit Suisse. A Swiss lender has issued its 6th profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the 2nd quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. Here in the UK, Bloomberg understands that Boris Johnson will go ahead with legislation to override parts of the Brexit deal.
That risks inflaming tensions with members of his very own Conservative Party and the European Union. The Prime Minister's government has been pushing to rewrite the Northern Ireland Protocol that keeps the region in the EU single market while creating a customs border with the rest of the UK. Former German Chancellor Angela Merkel warns that isolating Russia is not possible long-term. In her return to the public arena, Merkel said in an interview that Vladimir Putin made a big mistake by invading Ukraine, but she said there is a danger of Putin forming an alliance with China if he does get boxed in. In San Francisco, residents have voted to recall progressive district attorney Chaser Bodine. Bodine tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voting favored ousting him. He will be replaced by an interim district attorney chosen by the mayor of London Breed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. This
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
In honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Bringing inflation down should be our #1 priority, and President Biden, in an op-ed on inflation in recent remarks, has indicated that it is our top priority.
Janet Yellen, the Secretary of the Treasury, in the crosshairs, under the spotlight, through all of this over the last couple of weeks in a much bigger way. From New York City this morning, good morning to you all. Tom Keane, Lisa Bramett and Jonathan Ferro. Futures negative 20. We're down 0.5% on the S&P. Yields higher by 3 basis points, back through 3 on a 10-year, 3.0030%. On a WTI call right now, Tom, WTI up by 1.24%, 120.88. And I'm just looking at the average gas price, Tom, just inching away, closer and closer to $5.
So it's jump condition Wednesday here. We've got yen moving out near 134 level, weaker yen. Brent crude 122 moments ago. John, I do want to know, we finally had a breakout of a trend here on Turkish lira that's, I get it, John, it's idiosyncratic, but I'm sorry, you've got to watch it, particularly with the geopolitics of the Black Sea. We're going to do more data checks today, folks. I mean, there's some really interesting nuances going on. Right now, we're going to do a little bit of politics, because the politics folds into the economy, because we've been told for years that the elections of America are about the economy. It's the economy, stupid. Maybe not. Emily Wilkins joins us with a brief on the first Tuesday of June, or second Tuesday of June, the elections last night. Emily, I'm going to cut to the chase. Defund the police didn't work out. What is next for the progressives and liberals of this nation who, as a generalization, were crushed last night?
Well, they have to figure out a new way and a new message of moving forward, because between the Los Angeles mayoral race and the San Francisco attorney general, the message was very clear last night. Voters are responding to the high levels of crime that we're seeing in a lot of cities, and they're rejecting some of those progressive policies put out there that are saying go tougher on police and easier on criminals. And you saw President Biden really latch on to this after Eric Adams won the New York mayoral race, saying that, you know, he did not support defunding the police. He wanted to support the police. He wanted to have their back. And it's Democrats really trying to figure out measures where they can both hold the police accountable while not necessarily defunding them. Being able to say, hey, we are giving police departments more money. We are giving officers more support, but we're also setting limits on things like, say, no-knock warrants.
Bring it back to your Washington. The senators from West Virginia and Arizona, they're not progressive. They're not liberal. Where's the new definition of the middle ground for the Democratic Party, given what we see? Is the middle ground Speaker Pelosi?
I mean, I think I would even say it's probably a little bit more to the right of Speaker Pelosi. I mean, she likes to pride herself in being a progressive, but obviously as leader, she tries to stay on message as much as possible. And she's aware right now of what the mood in the country is. She's aware of that President Biden's approval ratings are quite low, that Republicans have a huge leg up in this midterms if you look at the polling that's being done right now. And there's an awareness that voters, their appetite right now is not really for more progressive candidates. At the same point, in some of these primaries, because of the voters who come out and vote, tend to be more towards the left and the right of their respective parties on the whole, you are seeing some progressive candidates go ahead and win over more moderate candidates across the country. I think, Tom, a lot of this is going to come down to what districts they run in. Even last night, we saw some Republicans who have bucked Trump on certain things slide to victory in states like New Jersey that tend to be a little more purple to blue. But in states like deep red Mississippi, we saw Republican members who took very similar votes, see very strong challengers in their primaries be forced into runoffs. And so it kind of seems to boil down to exactly where in the country you're running as far as what your policies need to be and how aligned for Republicans they need to be behind the former president.
Emily, I just hear Tom's voice in my head saying, it's the economy, stupid. It's the economy, stupid. It's $4.92 on average for a gallon of gasoline in the United States. And this is something that talking points cannot cannot get around. What is the cohesive plan for Democrats to address this, as it seems like there is not a ceiling in sight?
I mean, you're absolutely right. I think for primaries, it's a unique dynamic, but when it comes to the general, it is absolutely going to be about that inflation, about those gas prices, about how much a gallon of gas is. And Democrats, they've really tried to get the focus off of inflation. I mean, you heard Secretary Janet Yellen say yesterday, kind of pointing out that inflation is also happening in other developing countries throughout the world. You've heard Democrats really talk about trying to lower prices on various things. I think you're going to be hearing more of that as we potentially see progress being made on the legislation that passed about U.S. competitiveness with China. That's the bill that has the $52 billion for semiconductors in it. It's something that lawmakers from both sides of the Capitol, from both parties, are working on negotiating right now. And it's something that leaders have identified as potentially easing some supply chains, helping get some of those prices back down. I think you're going to be seeing a lot of focus on that. But to a certain extent, a lot of what's going on with inflation, you can't control it from Washington, D.C. You can't control it from the White House. And I think to a certain extent, Democrats know that they are in trouble come November.
You can try and control the message. And when it comes to messaging, Secretary Yellen has been the focal point for a lot of people over the last few weeks. Emily, is there a question mark on Secretary Yellen's future at the moment?
We haven't really been hearing too much of that here in Washington. I think there's just a number of other things to focus on at this point. Certainly, she wasn't the only one to incorrectly call that inflation transitory. I think there is a sense that, she was able to kind of stick to the messaging, stick to the talking points yesterday when she spoke with lawmakers on Capitol Hill. At this point, I think there's more pressing issues in D.C. rather than the future and the fate of Secretary Yellen. She had a lot of goodwill going into the role, a lot of expertise, a lot of support. And I think she has maintained that even as she has admitted that she was wrong about inflation.
Emily Wilkins, thank you, of Bloomberg Government down in D.C. I promised us a minute of some Bramo coverage on consumer credit in America. Lisa, it is going higher, and it's going higher.
So the Fed put out a report yesterday talking about how consumer credit has risen yet again in April after a record surge in the prior month. Why? This is my question, right? How much are we seeing consumers confident about their future versus not caring? They can get credit, they can lever up, and then prices don't matter. How much is this the scenario? Which side of the coin as we talk about the strength of the consumer? And frankly, on the other side, you do see banks wanting to extend credit because they need to make those loans. So they have an incentive. They're incentivized lenders at a time when consumers need to spend. It's not a clear picture to me.
Tom, what do you make of it?
I think that things have tightened up because of the core costs across the American deciles. The lower deciles are flat out doing better. There's no question about that. But the great middle class is looking at the monthly bills in a nominal space, John. They're looking at nominal mortgage, nominal rent, nominal gas, nominal auto, all that kind of thing. And it's killing them, and they've hit the charge cards to boot.
Lower and middle income groups getting squeezed and getting squeezed a bit more by gas prices pushing $5 a gallon. Got some Brits listening in thinking, $5 a gallon, come on, it's nothing. Except it is. It's something. It's a whole lot if you budget for something and then it increases by a huge amount. Futures down by 19 points on the S&P. We're down by about 0.5% from New York City. This is Bloomberg.